Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is entitled, "The Federal Regulators' Response to Recent Bank Failures." And without objection, all members will have five legislative days within which to submit extraneous material to the chair for inclusion for the record. I now recognize myself for 4 minutes to give an opening statement. Today, let's put aside the pre-baked narratives that have dominated the political discourse. We're here because the American people deserve answers. Before we draw conclusions on regulation or changes to law, we need to establish the related facts. In the run-up to its failure, Silicon Valley Bank experienced rapid growth, relying on undiversified and deposit base and investments made risky by a high inflation environment. We know the bank was mismanaged. That much is clear. Now we need insight into the decisions and decision-making process of financial regulators related to the second and third largest U.S. bank failures. We need insight into those key days in March when an idiosyncratic bank became a systemic risk, spawning a large-scale financial intervention that's still ongoing. Vice Chair for Supervision Barr, you've been on the job for less than a year. You came to the job well qualified. However, you made time to start a review of climate risks in banking and a review of capital standards for larger banks, with no mention of changes to bank supervision or liquidity provisions, two matters at issue with this bank failure. In fact, I've never heard you say to Congress that you didn't have the tools to do your job. In fairness, though, neither Dodd-Frank nor that technical corrections law, S-2155, dealt with issues presented in March. A digital bank run, the speed and volume of which had never been seen before. This committee would like to understand your thinking in the key hours of that first week in March, where your decisions had a mighty impact. Was there adequate planning for a large-scale bank run? Did the chief supervisor follow the playbook to ensure the bank did not fail? How did the chief supervisor and examiners miss the hole in the bank's balance sheet? These are related questions. Additionally, the committee has no insight into the decision-making or the actions of the FDIC chair on Friday the 10th through Sunday of that week when that systemic risk exception was announced. Again, did the FDIC chair use all the tools at his disposal to resolve the banks that weekend? Was there a viable private sector solution? There are reports that multiple banks were interested and ran the traps internally to purchase Silicon Valley Bank that weekend. You confirmed as much yesterday, Chairman Gruenberg. But as we all know, Silicon Valley Bank was not purchased until late Sunday, March 26th, at an estimated $20 billion in losses to the Deposit Insurance Fund. Why wasn't a potential buyer accepted sooner? Was there an ideological lens that prevented the FDIC from pursuing a private sector solution that could have staved off the uncertainty of the last 2 weeks? We know on Sunday, March 12th, another bank is shuttered and placed into FDIC receivership, and together this is deemed a systemic risk event. That evening, the Financial Stability Oversight Council meets in executive session. No meeting minutes, no transparency for the public, just an announcement after the fact. That lack of transparency has a negative effect on the public view of the safety of the financial arena. Congress needs visibility into how and why this determination was made by the FDIC, the Fed, the Treasury Secretary, the FSOC chair, and the President. I'll finish with this. We need competent financial supervisors, but Congress can't legislate competence. Today, this committee wants to understand your thinking in those key moments and that decision-making in a moment of stress in our banking system. Thank you for being here and your willingness to give answers to our questions. At least that's the hope. With that, I now recognize the ranking member for 4 minutes.
Good morning. I'd like to thank Chairman McHenry for working with me in a bipartisan way on investigating the failures of Silicon Valley Bank and Signature Bank. Today's hearing is the first of what I expect to be several hearings on this important topic. Chair Gruenberg, Vice Chair Barr, and Undersecretary Liang, the collapse of SVB and Signature Bank earlier this month marked the second and third largest bank failures in U.S. history. In fact, SVB customers withdrew a staggering $42 billion in less than a day, making it the largest bank run ever and threatening to snowball into a full-blown banking crisis. But 2023 is not 2008 because of the Dodd-Frank reforms Democrats on this committee passed, as well as the bold and swift response by President Biden. Secretary Yellen and our banking regulators, a crisis was averted and our banking system remains strong. However, these events are a wake-up call. We must uncover how management, regulatory, and supervisory failures contributed to these events and explore solutions to strengthen the safety and soundness of our banks. Small business owners should not be expected to serve as a financial regulator when paying their employees, and community banks and minority depository institutions should not have to pay for the failures of bank mismanagement at SVB or Signature Bank. Since day one, SVB's collapse, committee Democrats have been on the case. In fact, under my leadership as ranking member, we quickly organized several bipartisan briefings with our nation's regulators to better understand what happened, share what we were hearing from constituents, and urge regulators to act. Since then, we've sent letters demanding answers from our regulators, and in response to Biden's call to Congress, I and my colleagues are working on legislation to, for example, enhance clawbacks and other penalties. We also need answers from the CEOs who not only ran these banks into the ground, but enriched themselves. It is also important to know how we got here. Deregulation. Former and disgraced President Trump said he'd do and I'll quote, a big number on Dodd-Frank, and his appointed regulators did just that. At that time, I sounded the alarm on the dangers of weakening capital and liquidity rules for banks like SVB. The light touch cautions from the Fed to SVB management are clearly not what Congress intended for bank supervision. I hope Republicans will join Democrats in strengthening compliance with bank rules and transparency over this process. Before I close, I want to address the extreme MAGA Republican narrative about the bank failures. Let me be very, very clear. Silicon Valley Bank collapsed because of management failures and possible regulatory weaknesses, not because there was one black man on the board. We saw the same racist playbook during the 2008 financial crisis when some Republicans blamed the Community Reinvestment Act and loans made to people of color. Rest assured, Democrats will not stand for this blatant racism. With that, Mr. Chair, I yield back the balance of my time.
We'll now recognize the Vice Chair of the full committee, Mr. Hill, for 1 minute.
Thank you, Mr. Chairman. Today we're confronted with the results after 10 years of too loose monetary policy and recent wildly excessive spending. Some bank management teams have forgotten their prudential obligations to their depositors and their shareholders. And clearly, many customers forgot their own prudence and their own financial responsibility. But as our committee comes together, the chair, the ranking member, and members are concerned about the supervisory failures by the regulators who are supposed to keep a watchful eye. Some lawmakers have been quick to use this crisis to put politics to push their preferred policy outcomes. But that's premature. We need to first understand what happened, when, and why, both leading up to the bank failures as well as the decisions made by your agencies represented in our panel today in response. Only then can we decide the proper path forward. That's why Republicans are conducting a comprehensive review, starting with oversight letters to the Federal Reserve, the San Francisco Fed, the FDIC, the FSOC, the California and New York State regulators. We expect your full cooperation in this matter, and make no mistake, today's hearing is just a first step in that process. I thank the chair for the hearing, and I yield back.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair McHenry and Ranking Member Waters, for convening at this crucial time, and thank to our esteemed witnesses for being here today. I remain proud of what we did almost 13 years ago with the Dodd-Frank Act. Although COVID presented novel and considerable challenges to our banking system, the system held. And these recent events represent the first real stress event since the 2008 crisis, when banks dealt with run risk and serious liquidity concerns. What we've learned is that we now have to reinforce our banking system against bank runs that can occur at the speed of the internet. This will require stronger emergency liquidity provision to banks under attack, and it has to be available 24 hours a day, 7 days a week. This will then require liquidity providers to have a clear and simple means of knowing that they are loaning to an entity which will ultimately remain solvent. I also believe that we have a lot to learn by the two side-by-side bank failures, Silicon Valley Bank with total assets less than 1% of GDP, and Credit Suisse with total assets greater than 100% of Swiss GDP. And the difference, I believe, is contingent capital. Had we followed Congress's direction to include contingent capital into the stacks of U.S. large banks, we would have been able to resolve the SVB without hitting the Deposit Insurance Fund. And I'll be bringing that up in my questions and yield back.
Today we'll hear testimony from the Honorable Michael S. Barr, Vice Chair of Supervision of the Federal Reserve Board of Governors, the Honorable Martin J. Gruenberg, Chairman of the Board of Directors of the Federal Deposit Insurance Corporation, and the Honorable Nellie Liang, Undersecretary for Domestic Finance of the U.S. Department of Treasury. We thank each of you for your time, and we're going to be recognized for 5 minutes for an oral presentation of your written testimony. We'll begin with you, Mr. Barr.
Chairman McHenry, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify today on the Federal Reserve's supervisory and regulatory oversight of Silicon Valley Bank. Our banking system is sound and resilient, with strong capital and liquidity. The Federal Reserve, working with the Treasury Department and FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that we are committed to ensuring that all deposits are safe. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as necessary.
If the gentleman will dispense for a second. Mr. Foster, you'll turn off your mic. Thank you. We'll let you continue. Thank you.
Shall I proceed?
Oh, all right. Go ahead. If everybody will check your mics and make sure you're off. Did you just do that to Mr. Torres? All right. See, we can even have a sense of humor in the midst of serious stuff. We'll let you continue. Thank you, Vice Chair Barr.
Thank you, Mr. Chair. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as needed to keep the system safe and sound. At the same time, the events of the last few weeks raise questions about what more can be done and should be done so that isolated banking problems do not undermine confidence in healthy banks and threaten the stability of the banking system as a whole. At the forefront of my mind is the importance of maintaining the strength and diversity of banks of all sizes that serve communities across the country. SVB failed because the bank's management did not effectively manage its interest rate and liquidity risk, and the bank then suffered a devastating and unexpected run by its uninsured depositors in a period of less than 24 hours. Immediately following SVB's failure, Chair Powell and I agreed that I should oversee a review of the circumstances leading up to SVB's failure. In this review, we are looking at SVB's growth and management, our own supervisory engagement with the bank, and the regulatory requirements that applied to the bank. The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. Supervisors began delivering supervisory warnings near the end of 2021. Our review will consider whether these supervisory warnings were sufficient and whether supervisors had sufficient tools to escalate them. We are also focusing on whether the Federal Reserve's supervision was appropriate for the rapid growth and vulnerabilities of the bank. While the Federal Reserve framework focuses on size thresholds, size is not always a good proxy for risk, particularly when a bank has a non-traditional business model. Turning to regulation, we are evaluating whether application of more stringent standards would have prompted the bank to better manage the risk that led to its failure. We are also assessing whether SVB would have had higher levels of capital and liquidity under higher standards, and whether such higher levels of capital and liquidity could have forestalled the bank's failure or provided further resilience to the bank. We need to move forward with our work to improve the resilience of the banking system, including the Basel III endgame reforms, a long-term debt requirement for large banks, and enhancements to stress testing with multiple scenarios so that it captures a wider range of risk and uncovers channels for contagion, like those we saw in the recent series of events. We must also explore changes to our liquidity rules and other reforms to improve the resiliency of the financial system. In addition, recent events have shown that we must evolve our understanding of banking in light of changing technologies and emerging risks. Part of the Federal Reserve's core mission is to promote the safety and soundness of the banks we supervise, as well as the stability of the financial system, to help ensure that the system supports a healthy economy for U.S. households, businesses, and communities. Deeply interrogating SVB's failure and probing its broader implications is critical to our responsibility for upholding that mission. Thank you, and I look forward to your questions.
We'll now recognize Chairman Gruenberg.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you very much for the opportunity to appear before you today to address the federal regulators' response to the recent bank failures. On March 10th, just over 2 weeks ago, Silicon Valley Bank, or SVB as it's known, with $209 billion in assets at year-end 2022, was closed by the California Department of Financial Protection and Innovation, which then appointed the FDIC as receiver. The failure of SVB, following the March 8th announcement by Silvergate Bank that it would voluntarily liquidate, signaled the possibility of a contagion effect on other banks. On Sunday, March 12th, just 2 days after the failure of SVB, another institution, Signature Bank of New York, with $110 billion in assets at year-end 2022, was closed by the New York State Department of Financial Services, which also appointed the FDIC as receiver. With other institutions experiencing stress, serious concerns arose about a broader economic spillover from these failures. After careful analysis and deliberation, the boards of the FDIC and the Federal Reserve voted unanimously to recommend, and the Treasury Secretary, in consultation with the President, determined that the FDIC could use emergency systemic risk authorities under the Federal Deposit Insurance Act to fully protect all depositors in winding down SVB and Signature Bank. It's worth noting that these two institutions were allowed to fail. Shareholders lost their investment, unsecured creditors took losses, the boards and the most senior executives were removed. The FDIC has authority to investigate and hold accountable the directors and officers of the banks for the losses they caused to the banks and for any misconduct in the management of the banks, and the FDIC has already commenced those investigations. Further, any losses to the FDIC's deposit insurance fund as a result of uninsured deposit insurance coverage will be repaid by a special assessment on banks as required by law. The FDIC has now completed the sale of both bridge banks to acquiring institutions. My written testimony today describes the events leading up to the failures of SVB and Signature Bank and the facts and circumstances that prompted the decision to utilize the authority in the Federal Deposit Insurance Act to protect all depositors in those banks following those failures. It further describes the management and disposition of the bridge institutions that were established. It also discusses the FDIC's assessment of the current state of the U.S. financial system, which remains sound despite these events. And in addition, it shares some preliminary lessons learned as we look back on the immediate aftermath of this episode. In that regard, the FDIC will undertake a comprehensive review of the deposit insurance system and will release a report by May 1 that will include policy options for consideration related to deposit insurance coverage levels, excess deposit insurance, and the implications for risk-based pricing and deposit insurance fund adequacy. In addition, the FDIC's Chief Risk Officer will undertake a review of the FDIC supervision of Signature Bank and will also release a report by May 1. Further, the FDIC will issue in May a proposed rulemaking for the special assessment for public comment. The bank failures demonstrate the implications that banks with assets over $100 billion can have for financial stability. The prudential regulation of these institutions merits serious attention, particularly for capital, liquidity, and interest rate risk, and also the consideration of a long-term debt requirement to facilitate orderly resolution. Recent efforts to stabilize the banking system and stem potential contagion from these failures have ensured that depositors will continue to have access to their savings, that small businesses and other employers can continue to make payrolls, and that other banks, small, medium, and large, can continue to extend credit to borrowers and serve as a source of support. The FDIC continues to monitor developments and is prepared to use all of its authorities as needed. The FDIC is committed to working cooperatively with our counterparts at the other federal regulators, as well as with policymakers in the Congress, to better understand what brought these institutions to failure and what measures can be taken to prevent similar failures in the future. Mr. Chairman, that concludes my statement. I'd be glad to respond to questions.
Thank you. Undersecretary Liang.
Ranking Member Waters, members of the committee, thank you for inviting me to testify today and for the opportunity to speak several times in recent weeks to share updates from Treasury regarding current events. The American economy relies on a healthy—
If you'd pull your mic closer and, or direct it towards you. Thank you.
The American economy relies on a healthy and diverse banking system, one that includes large, small, and mid-sized banks, and provides for the financial needs of families, businesses, and local communities. Nearly 3 weeks ago, problems emerged at 2 banks with the potential for immediate and significant impacts on the broader banking system and the economy. The situation demanded a swift response. In the days that followed, the federal government took decisive actions to strengthen public confidence in the U.S. banking system and to protect the American economy. On March 9th, depositors of Silicon Valley Bank withdrew $42 billion in deposits in a period of just a few hours. After concluding that significant deposit withdrawals would continue the next day, the California state regulator closed SVB and appointed the FDIC as receiver. 2 days later, the New York financial regulator closed Signature Bank, which also had experienced a depositor run, and appointed the FDIC as receiver. Treasury worked to assess the effects of these failures on the broader banking system, consulting regularly with the Federal Reserve and FDIC. On Sunday evening, recognizing the urgency of reducing uncertainty for Monday morning, Treasury, the Federal Reserve, and the FDIC announced a number of actions to stem uninsured depositor runs and to prevent significant disruptions to households and businesses. First, the boards of the FDIC and the Federal Reserve recommended unanimously, and Secretary Yellen approved after consulting with the President, 2 actions that would enable the FDIC to complete its resolution of the 2 banks in a manner that fully protects all of their depositors. These actions ensured that businesses could continue to make payroll and that families could access their funds. Depositors were protected by the Deposit Insurance Fund. Equity holders and bondholders of the banks were not covered. Second, the Federal Reserve created the Bank Term Funding Program, a new facility to provide term funding to all insured depository institutions eligible for primary credit at the discount window, based on their holdings of Treasury and agency debt securities. This program, along with the pre-existing discount window, has helped banks to meet depositor demands and bolstered liquidity in the banking system. This two-pronged, targeted approach was necessary to reassure depositors at all banks and to protect the U.S. banking system and economy. These actions have helped to stabilize deposits throughout the country and provided depositors with confidence that their funds were safe. In addition to these actions, on March 16th, 11 banks deposited $30 billion into First Republic Bank. The actions of these large and mid-sized banks represent a vote of confidence in the banking system and demonstrate the importance of banks of all sizes working to keep our economy strong. Moreover, on March 20th, the deposits in certain assets of Signature Bridge Bank were acquired from the FDIC, and on March 26th, the deposits in certain assets of Silicon Valley Bridge Bank were acquired from the FDIC. We continue to closely monitor developments across the banking and financial system and coordinate with federal and state regulators. As Secretary Yellen has said, we have used important tools to act quickly to prevent contagion, and they are tools we would use again to ensure that American deposits are safe. Looking forward, while we do not yet have all the details about the failures of the two banks, we do know that the recent developments are very different from those of the global financial crisis. Back then, many financial institutions came under stress because they held low credit quality assets. This was not at all the catalyst for the recent events. Our financial system is significantly stronger than it was 15 years ago. This is in large part due to the post-crisis reforms for stronger capital and liquidity. As you know, the Federal Reserve announced a review of the failure of SVB and the FDIC a review of Signature Bank. I fully support these reviews and look forward to learning more in order to inform any regulatory and supervisory responses. We must ensure that our bank regulatory policies and supervision are appropriate for the risks, old and new, that banks face today. Thank you to the committee for its leadership on these important issues and for inviting me here to testify today. I look forward to your questions.
I recognize myself for 5 minutes for questions. Undersecretary Liang, when did you become aware of the severe financial distress of Silicon Valley Bank?
Chairman
Date and
McHenry,
time would be helpful.
We became aware.
When did you become aware? I'm going to
I became aware of issues at Silicon Valley Bank on Wednesday or Thursday.
Wednesday or Thursday?
Yes.
I would like to have a written response to when you became aware. You can search your email, that'd be helpful. Vice Chair Barr, when did you become aware?
Thank you, Mr. Chair.
When did you become aware of SVB's
Sorry.
financial distress?
I was going to answer that Thursday morning I received an email from staff indicating that Wednesday evening the bank had difficulty.
Thursday morning. When did you become aware, Vice Chairman?
I believe it was Thursday evening. Staff came into a meeting I was at.
Thursday evening for Silicon Valley Bank. Okay. Along those lines, and you had a staff presentation in February that included Silicon Valley Bank and the distress because of rising interest rates on their portfolio. What did you do between that February staff presentation to you and the week of March 6th about Silicon Valley Bank?
Staff presented on the interest rate risk.
Yes, that's what I said. That was the February presentation. What did you do as Vice Chair of Supervision between that time and the bank, the week of the bank failure?
Staff indicated that they were completing their review of the bank and of this broader horizontal review at that time, and I was waiting for the results of that review.
Were you aware of Silicon Valley Bank raising capital the week of March 6th?
I believe I became aware of that in this email that I described to you.
On Thursday morning, that they had successfully raised the capital, but they were facing financial distress.
I was not aware Thursday morning that there were deposit outflows. I was trying to finish the answer to that question. I was aware of the difficulty Wednesday night in raising capital, but the bank was reporting to supervisors Thursday morning that deposits were stable.
When did you become aware of the deposit flows on Thursday?
Thursday afternoon, late afternoon, I became aware of deposit flows, and Thursday evening that there was essentially a bank run.
So Thursday afternoon, which could be mid-morning in California? Is that what you're suggesting?
I believe it was around noon in California, and for me, around 3 o'clock.
Okay. And did you make provision for the discount window or pledgeable assets at that time you heard of their distress?
My understanding from the staff is they were in discussions with the bank itself beginning Thursday afternoon to try and move pledgeable collateral over to the discount window. That work continued Thursday afternoon, Thursday evening, and actually overnight.
Did you make provision to keep the discount window open so they could provision collateral to avoid a bank collapse?
The discount window opening decision is sort of like a standard thing. It normally closes.
A standard
at 7
thing,
p.m.
except in a moment of crisis. It can be kept open. I think the vice chair for supervision should be able to make that phone call. Did you provision for that? Or did you think you needed a provision for that?
Mr. Chairman, at the time, my understanding was that the difficulty wasn't sending funds. The difficulty was actually getting the collateral, evaluating the collateral, and getting it pledged to the discount window. And staff were working with Silicon Valley Bank basically all afternoon and evening and through the morning the next day to pledge as much collateral as humanly possible to the discount.
So on Friday morning, Vice Chair, Chair Gruenberg, you were appointed receiver. When did you become aware that FDIC was going to have to take this measure, or was going to receive this bank?
I think when we were informed Thursday evening.
I mean you. Were you informed Thursday
I was
evening?
informed Thursday evening by staff. That
Which meant you had Friday morning conference calls to make a decision. Was that part of it?
I think we were, I think we knew Thursday evening that the bank was going to fail and that we needed to make provision to take over the institution.
Did you pick up the phone and call the vice chair of supervision at the Fed and say, how can we provision to keep this institution open for a Friday?
I can't recall that. My recollection is, Mr. Chairman, that the institution was experiencing a liquidity failure and that it was going to fail. And
It was going to fail on Friday open or Friday evening? Were you provisioning for this for the weekend decision?
No, I think the expectation and their experience was that the institution was going to be closed in the morning.
At what point did you open an auction for Silicon Valley Bank? On Friday?
I believe it was Sunday afternoon.
Sunday afternoon, you opened for auction. So that weekend, what happened we only heard the announcement of Congress receiving this information at 11:20 on Friday morning. There was an idiosyncratic bank. And Sunday afternoon was the next pronouncement from any of you three on the panel, and it was a systemic risk designation. That's what shook the market for the last 2 weeks. That's the reason why we've had these extraordinary interventions in the financial system. And I want to know the key details of that weekend. I hope we can drill into those questions.
Sure.
With that, I'll recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Chair Gruenberg, we know that SVB Bank, nearly half of all U.S. venture-backed startups, potentially tens of thousands of companies, which clearly posed a concentration risk to the bank. While most of the bank's depositors were small and mid-sized businesses, they also had large customers too, with the top 10 accounts holding more than $13 billion in combined deposits. Chair Gruenberg and Vice Chair Barr, I'm concerned that depositors' decision to run or stay were not necessarily made on their own, but by the strong encouragement of their venture capital backers who sit on the boards and hold equity in their companies. Were a handful of large venture capital depositors able to influence the withdrawal of $42 billion all at once through their control over their portfolio companies?
Congresswoman, You know, I think that is something we'll need to look at in terms of the post-failure review of these institutions. I couldn't tell you today, with certainty what occurred there. I know both the Fed in regard to SVB and we in regard to Signature are going to do a careful review of the events that occurred.
Thank you very much, and I agree with you. I think we really need to know the role that venture capitals played in this bank. Going further, Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, which is considered deficient, but was considered sufficiently capitalized, given the bank's unique customer base, extremely large share of uninsured deposits, and underwater asset portfolio. Liquidity management was also a key issue. The liquidity rating for a bank should account for interest rate risk and the bank's asset liability management. What was the bank's rating on liquidity?
Thank you, Representative Waters. My understanding is in the summer of 2022, although the composite rating was a 3, that is not well managed, the liquidity rating was a 2, which would have been satisfactory. And one of the things we're looking at in the review is how that synced up with the supervisory matters requiring attention and matters requiring immediate attention with respect to liquidity that had previously been issued. So we're looking at whether those standards were sufficiently stringent, whether the firm should have been downgraded further, and whether further supervisory steps should have been taken.
Whose responsibility was it, understanding the deficient rating, to do something?
The Federal Reserve is responsible for supervising this institution.
Did the Federal Reserve fail on that?
I think that anytime you have a bank failure like this, bank management clearly failed, supervisors failed, and our regulatory system failed. So we're looking at all of that.
Thank you. Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, and you just responded in a way that says, yes, that is true, and perhaps something should have been done, and you're going to look further at that. Are you suggesting perhaps legislation to deal with that?
We're focusing in our review on our own supervision, ways that we could have done better as supervisors at the Federal Reserve, and ways that our own regulatory structure might have played a role with respect to the failure of this firm. So we're inward looking. It's a self-assessment, a prudent thing, I think, for us to do. It's what we tell banks to do. It's sort of the first thing you have to do to understand risk within your own institution, and that's why we're doing it.
Chair Barr, I wonder what it would take to receive a 3, 4, or 5 from a federal examiner. Well, I know the idea is to keep exam ratings confidential in order to prevent bank runs, but doing so also prevents this committee from understanding how well the Fed and other regulators are doing in rating banks. In the same way that stress testing results are public, are there ways we can make the supervisory process more transparent to promote discipline and accountability?
Thank you, Representative Waters. I think one of the things we're trying to do here today is to provide that accountability, and we'll do that in our report, which we'll do on May 1st. It will include confidential supervisory information. We normally do not provide that information, but given the fact that this bank failed and triggered a systemic risk exception, we're including that information, including exam reports.
Thank you very much. Very important issue. Chair Gruenberg, Silicon Valley Bank was purchased over the weekend by First Citizens Bank and Trust Company. As you know, I wrote to you on March 18 about former SVB's Community Benefits Plan, which was intended to provide $11 billion in small businesses, housing, and community development support to communities in my home state of California and in Massachusetts. I understand that $2 billion in affordable housing and other projects may be lost or delayed in California because of the failure. Will Citizens Bank and Trust continue implementation of the former bank's community benefits plan?
The agreement between the community organizations in Silicon Valley in regard to the community benefits agreement was an agreement between those two parties. First Citizens will now be taking over Silicon Valley. There'll be an opportunity for the community organizations to engage with First Citizens I know First Citizens has a community benefits agreement with community organizations where it's currently doing business. So there'll be an opportunity for the groups in California to engage with Citizens. And I would note Citizens is also subject to supervision under the Community Reinvestment Act. And so we'll be able to evaluate the degree to which Citizens is serving its
Ladies-
communities pursuant to CRA.
Gentlelady's time has expired. We'll now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas, for 5 minutes.
Thank the chairman, thank the ranking member for this prompt hearing after these weeks of tumult, and thank the panelists for being here as well. Mr. Barr, when were you nominated for your job?
I apologize, I don't have the date in my head. It was the spring of last year.
And do you know when you were confirmed for your job?
Yes, I took my post up in July of last year, July 2022.
July of 2022. So between January 20th, 2021 and July of 2022, who was in charge as Vice Chairman of Supervision at the Federal Reserve?
There was no vice chairman for supervision during that time period.
And so when that happens, what's the Fed's process for delegating that authority to another member of the Board of Governors or a staffer, or how's that work?
I apologize. I don't know the technical answer to that question. We'll have to get back to you with a written
Yeah,
response.
if you
about
get
that
back to me,
delegation.
because what we're saying to my colleagues here is that from the turn of administration, we did not have a Vice Chairman of Supervision from January 20, 2021 until July of 2022, and that is precisely the time frames, colleagues, when this bank's business strategy went awry and was under this supervisory concern by the San Francisco Fed. So I just want to have that in the record. And when I look at the results of this bank and the UBPR, the call report data, and looking at your good testimony about the timeline that you've disclosed, it appears to me that we have a lack of supervisory urgency here. You outline that the trends in 2021 are what triggered concern by the Federal Reserve examiners, and I assume the state of California. We haven't heard from the state of California. We'd like to. But there was an exam in the summer of 2021, and then there was, it took till the fourth quarter of 2021 to tell the bank we had some specific serious concerns, so that you met with the board then, not you, but the supervisors. And then the downgrades didn't come, and those tough visits didn't come till the summer of 2022. So really 12 months of discussion between the board and the state of California and the San Francisco Fed. That doesn't sound like a very urgent supervisory process. What is it? Do you consider that urgent to take a full 12 months in that process?
Mr. Hill, I think you raise an absolutely essential question. It's one of the things we're going to be asking in our review. Obviously, these events occurred before I arrived at the board. I'm going back and looking at what steps were taken and not taken. And I think it's a completely fair question. Should the supervisors really, been much more aggressive in the way that they responded to the risks that they saw and they were noting? And we're going to look carefully at that.
Yeah.
I think it's
I was shocked with the business plan, way out of line with peer. You have matters requiring attention, which is a very low level, the lowest level editorial comment by a bank regulator. There was no proposal for a board resolution that I saw in your notes. So I look forward to the results of your comments. On this issue of Dodd-Frank versus S-2155, my reading of bank law, just those things are just almost not important compared to 12 U.S.C. 1818 on cease and desist, where the FDIC, the primary bank regulator, the state can do whatever they want to a bank that's not operating in a safe and sound manner. Isn't that right, Mr. Barr?
The bank regulators have substantial discretion to use those authorities
Right.
when banks are operating in an unsafe and unsound manner. I agree with that.
And I thought Senator Crapo's comment yesterday was very, very important, that in the rule of construction, that final bit of information in S-2155, the bipartisan bill, bicameral bill signed by President Trump, it says nothing in this bill shall be construed to limit the supervisory authorities for safety and soundness in any way. Isn't that what that rule of construction says?
Yes, I agree with that. I think we have substantial authority under existing law to regulate firms and supervise firms in a way that is appropriate for their risk and size and complexity.
Thank you very much. Mr. Chairman, talking about the resolution process, are you open to a full investigation, not only of the deposit insurance and not only of the supervisory process, but also look carefully at the resolution process itself?
Yes, Congressman.
And are you going to conduct that yourself, or would you work with us on that?
Well, we would certainly be prepared to undertake that review and be transparent with you in regard to it.
Something I want to see considered, and I argued this back in 2008 as a private citizen and banker, which is in the resolution process to consider non-bank buyers for these assets. Do you agree that's important? We should consider that?
Yes, it is, Congressman.
Thank you. I yield back.
We'll now recognize Ms. Velazquez of New York for 5 minutes.
Thank you, Mr. Chairman. Mr. Barr, the rescue of depositors in Silicon Valley Bank demonstrates that regulators think banks like Silicon Valley pose a systemic risk to the system, just like Gypsy do. Mr. Barr, don't you think Category 3 and 4 banks should face the same rules as the mega banks?
Thank you very much for that question. We are looking at capital and liquidity standards for all large banks, including firms 100 billion and above. I still think a tiering approach makes some sense. It doesn't have to be the same rules for all banks, but we do need stronger rules for firms of this size. Stronger rules on capital and liquidity, I think, are going to be really important.
Mr. Barr, in my view, the decision to insure all depositors was a necessary and correct step. However, I am frustrated that time and time again we fail to regulate them like one, and as a result we find ourselves in situations like the one that we are currently in. Without proper regulations that account for the systemic risk profile of a bank, we are incentivizing bankers to search for yield and inviting moral hazard. Mr. Barr, the sudden and immediate collapse of Silicon Valley Bank demonstrates the vulnerability of banks and the broader system to interest rate rises. Yet, under our current capital rules, most banks are not required to recognize this risk, only GSIBs. Will the Fed rewrite its rule to require all banks to account for interest rate risk?
Well, you raise an absolutely essential point, and one that we are very carefully looking at. We anticipate engaging in a notice and comment rulemaking process on capital rules with appropriate transitions, and that is one of the areas that I think would be important for us to consider in that rulemaking process.
So do you think that the rules passed under S-2155 and written by the Trump administration need to be rewritten?
We're going to look as part of our review at not only our supervisory issues, but also at the regulatory structure that the Federal Reserve put in place in 2019 and see whether the size thresholds we used, the standards we decided to put in place, all of that is on the table. We're reviewing that. We're going to come back and provide an assessment of that on May 1st.
Thank you. And Mr. Barr, the Fed has been raising interest rates more rapidly than it has in decades in an effort to lower inflation. It appears that many banks were unprepared for this. Can you explain how the Fed's bank supervision staff coordinate with its monetary policy-focused staff to ensure that banks are properly prepared for well-telegraphed shifts in monetary policy? Does the Fed see regulation and supervision as separate from monetary policy?
The whole of the Federal Reserve staff communicate very well together. As you noted, the monetary policy decisions were very well telegraphed. The decisions were essential to meet our congressional mandate of price stability and maximum employment. And we need to make sure that we continue to pursue that. We have separate tools that we use, of course, and as I said in other contexts, interest rate risk management is a core bread and butter issue in banking. It's not an esoteric issue, an exotic issue, a complicated issue. It's a straightforward issue, and the bank management failed to do that here.
Thank you. And during his news conference last week, Chairman Powell said that the FOMC considered a pause in the interest rate increases in light of the recent banking failures, but ultimately unanimously approved the decision to raise rates due to intermediate data on inflation and the strength of the labor market. How will the Fed balance its supervisory role with its monetary policy role as it considers future interest rate increase?
We have really all the tools that we need on the macroprudential and microprudential side to assess financial stability and bank safety issues. And as I said, the banking system overall is sound and resilient. Deposits are safe. On the monetary policy side, we're going to be looking at incoming data. We're going to be looking at changing financial conditions, and we'll really make a judgment on a meeting-by-meeting basis about that decision.
Thank you. Mr. Chairman, I yield back.
We'll now recognize Mr. Sessions for 5 minutes.
Mr. Chairman, thank you very much, and thank you to the witnesses for being here today. I think you see that this committee will work together, has questions, and would wish to hold you accountable, but I must confess to you, after hearing the questions that have taken place, I've heard none of you three accept real responsibility for your role in this endeavor. I've heard that you were aware of it the week of. I've heard that notice was given of oversight back in 21, that a frailty was noticed. I've heard us say that we used all of our tools. I've heard you say things like the FDIC will use all of its authorities. But I've not heard any of you three talk about a systematic failure to let the bosses know what's happening. I've heard you use, well, this got staffed and that got staffed and staff did this. I think this is a wake-up call to all three of you. I hope it's a wake-up call to your organization, that evidently they can see these bread and butter failures back in 2021, but evidently nothing realistic ever occurred to avoid what seemingly anybody that's a professional banker could see. I've seen excessive regulatory oversight by this administration across the board. I've seen a lot of what I would call inattention by decision makers. So I would specifically tell you that we will drill down on and need to know more about the recommendation for systematic exception that was invoked. In other words, that was invoked by presumptively the people at this table, and yet it took all this time to filter up before you were even aware. Failure was occurring, and then you were given notice. So I would hope, myself, that there would be some inward thinking about your actual roles. Instead of staffing everything and waiting for it to bubble up to you, that there should be hooks in place. I spent 16 years in the private sector, ran a large organization, over 700 employees. I had more than a fiduciary responsibility, I had a managerial responsibility to report up the things that we saw to a very large organization. And I believe, by and large, those people welcomed my feedback and set ourselves up for that. So take the remaining minute and 50 seconds and give me some inward thinking, because I heard no one say, we were part of the problem, we need to look at us being part of the problem, and we need to be a part of the solution, because, as was noted, this will be paid by all banks across the country of the FDIC. Please. Mr. Barr?
Thank you very much, Mr. Sessions. I agree with you. I think we need to take a good, hard look inside at the Federal Reserve, at our supervision, at our regulation. I think we need to be humble about that, and I think we are going to be unflinching in our review about that.
Does that include your role?
Absolutely. Absolutely. And I'm here today to be accountable to you for that purpose.
Well, accountable is one thing, but coming back and actually admitting that you were part of the systematic failure is an entirely different process. People say, well, we'll hold accountability, but actually it's banks that are across the country that play by these rules and offer this money are the backstop. And while I don't want to argue against that, I do want to say I believe there's lots of room to say someone should have caught this as early as and done something back in early 22. Chairman?
Congressman, I really don't mean to shirk responsibility here. I think we share responsibility. I think bank management had responsibility. I think we as the regulators of the institution had responsibility. I think we're going to conduct reviews to get the facts as to what occurred and a measure of internal as well as external accountability. My own sense here in terms of the supervision of these institutions from my perspective is that both agencies, and I would include ourselves, were aware that there were issues at these institutions and trying to address them through the supervisory process. It's also my judgment, I think, and we're going to conduct a review to get all the facts here, if I may say.
The gentleman can answer the rest for the record. With that, we'll now recognize Mr. Sherman of California for 5 minutes.
Due to Dodd-Frank, our banking system is strong. Our regulators avoided a crisis by quick action this month. But the solution was not free. Some $22 billion of special assessments will be imposed on banks. That will lead to lower rates on certificates of deposit, perhaps 0.25%, perhaps 1/8%. And our entire economy has been hurt. It's been rattled by what happened this month. Our bank regulatory system has some real flaws. It's an undemocratic system in which FASB writes the accounting rules and doesn't even claim to be part of a democratic government. The Federal Reserve Board's regional banks, it's not one person, one vote, it's one bank, one vote. The bankers vote on who's on the regional board, and the bankers of my state elected the CEO of Silicon Valley Bank. Banks get to pick their regulators, state or federal, holding company or no holding company, Fed or OTC. They can use regulatory arbitrage, and every regulatory agency knows that if it gets a reputation of being too tough, the banks can flee and go to one of their regulatory competitors. Our accounting system for banks is absolutely perverse. If you make a Main Street loan, you're penalized under the CECL system, and you will always list that loan on your balance sheet as being worth less than you paid for the note. If you instead go to Wall Street and buy long-term bonds, you are rewarded. If the bond goes up in value, you can sell it or classify it as available for sale and recognize a profit and justify a bonus. If the bond goes down in value, you can hide it by listing it as held for maturity and list it at the original purchase price on your balance sheet, even though you know it's worth 20 or 30% less. The crypto billionaires fan the flames because they understood that if they can besmirch our banking and dollar system, crypto goes up, and they've made tens of billions of dollars. Silicon Valley Bank could have saved itself in 2022 by hedging its risk or selling its long-term bonds, but they knew that would cut profits and bonuses. They decided to take the risk, and here we are. And of course, our clawback provisions are inadequate. There's $600 billion of unrecognized losses on the balance sheets of American banks. That needs to be juxtaposed with the $2.2 trillion of capital American banks have. So we're overstating the capital of our banking system by perhaps a quarter. Mr. Barr, particularly watched your Senate testimony in which you basically said it was bank mismanagement for them to ignore the good advice your people gave them. It is also misregulation to let banks ignore that advice. You are not running a consulting operation. You are running a regulatory operation who can force banks to follow that advice. And interest rates go up, interest rates go down. Certainly the Fed in auditing banks ought to know that, especially when this is not a 100-year event. Interest rates go up, interest rates go down. I mean, 2023 has its peculiarities, but it's particularly ironic. It's the Fed that's raising the interest rates, and then the Fed that's not examining banks to see if they can survive if interest rates go up. The concern we all have is, are there other banks that could go under because they invested in long-term bonds that aren't worth as much as they paid for them? So I'll ask Mr. Gruenberg and perhaps Mr. Barr, are there any banks out there, and roughly how many, that have capital of under 5% if you subtract from their stated capital their unhedged, unrealized losses on long-term debt?
Congressman, that's a fair question and a factual question. If I may, let us get back to you on that. We'll get the numbers and share them with you very quickly.
And please don't give me the names. Mr. Barr, do you have any other answer?
No, sir.
Mr. Gruenberg, I know that you're going to be giving us a report about possibly expanding FDIC insurance this spring. I look forward to it, and I hope that you would consider $3 million of coverage, but only of non-interest-bearing accounts. Because when a bank is used as a utility for a checking account, we need that coverage. If people are making investments, we ought to be a little bit more careful, and I'll yield back.
We'll now go to the Subcommittee Chair on National Security, Mr. Luetkemeyer, for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, for more than a year now, financial news has focused on Fed raising rates. There isn't a person in the financial services sector of the country that hasn't heard about it on a seemingly everyday basis since the beginning of 2022. Well, it has been the fastest rate increase in our country's history, which I believe is probably too fast. Chairman Powell has made his intentions very clear. No banks should have been caught off guard by rate increases. In fact, the Federal Reserve is in the same position themselves. Mr. Powell was here a couple weeks ago and acknowledged that his bond holdings have got them, and the interest rate situation that they have is actually losing money as a result of this himself. So it's even more surprising that a $100 billion bank's not considering the effect of rate increases is, in fact, according to your testimony, the Fed staff hasn't presented to the Board of Governors with its impacts on rising rates until mid-2023, February of 2023, just last month. So are you telling me that every time the Fed raises rates or drops rates, there is no economic analysis done on the impact on our economy?
Mr. Luetkemeyer, I was referencing that particular meeting because the staff
No,
mentioned...
that's not my question. My question is, does the Fed, before it raises rates or lowers rates, does it have an economic study done by its economists? They've got a team of economists there. Do you have an economic analysis done of the impact of that? Mr. Garbarino, would you please move to your right, please? Thank you.
Yes, we evaluate all the economic conditions.
Do you get a report
and
from your
financial
economists
conditions
that the
when
Fed,
making any interest rate
that
decision.
the Fed, does the Fed board get a report from their economists saying what the impact of their rates will be on the economy? Yes or no?
Yes, we get staff forecasts that forecast the expected impact on the economy of rate decisions.
Okay, how come you made a specific mention that of this in your February report then? Why did you specify that you got the rate?
That's what I was trying to explain earlier. I mentioned that because the report specifically called out Silicon Valley Bank. We regularly discuss interest rate problems. Interest rate risk is an important part of supervision and a bread and butter issue.
Okay, a bank this size, normally you'll have an examiner or two or a team that is in there on a daily basis. Was there an examiner or team of examiners in Silicon Valley Bank on a daily basis?
The team consisted of about 20 full-time equivalent staff at the San Francisco Federal Reserve Bank.
They were not in Silicon Valley then?
I don't know precisely the extent of their in-person meetings versus their remote analytic work.
Okay, that's another problem that we have to talk about, having all this work off-site whenever they need to be on-site, being able to have access to the daily data. But As a result of this, and I'll follow up on some of the questions that have been asked before, but ask them in a little bit different way. You knew that we had an interest rate risk problem and a liquidity problem. You acknowledged it all the way through from 2021. It's been established this morning. You have examiners in the bank are watching it on a daily basis. And you know that you've had some reports that say we need to take some action. Why was no action requested or not forced on the bank?
There was action requested of the bank in the matters requiring attention and matters requiring immediate attention.
Why were they not enforced?
I think that's a question for our review. We don't know. I don't yet know the answer. Could the staff have escalated more? Should they more? What were the interactions with the bank? That's all part of the supervisory record that will be in the May 1st report.
Well, that begs the question then, Mr. Barr. If you think you need more rules and you're not even enforcing existing ones, why do you need more rules? I don't think we need to look at more rules until we figure out which rules were not being enforced, what messages were not being delivered to the bank to be able to do your job. At that point, then we can take a look and see what we need to do something else. But for you to make the statement, we need more rules and regulations, how about enforcing the existing ones first?
We're going to be looking, as I said, at our own supervision under the existing framework, ways in which existing rules
very
might...
quickly, I've got one more quick question for you here. This situation points out a very unique situation because of the new social media, the world of instantaneously being able to do some things. I have grave concerns because within a less than 2-day period, $42 billion rolled off the books here, basically as a result of a Twitter little informational thing. It begs the question down the road here, Mr. Barr, it opens up the possibility whenever you have a bunch of significantly distressed banks that there could be a short sale on some of these things that could be out there. We need to be talking about that. Are you thinking about that at all yet?
Yes, I think you're raising absolutely important and critical questions about the role of social media, the role of networks, depositors with each other, and the potential.
You're working on a real-time payment system that's going to be ripe for a problem like this with Twitter if we don't fix it
Gentleman's
beforehand.
time's expired. You can
Thank you, Mr.
answer for the
Chairman.
record. We'll now go to Mr. Scott of Georgia for 5 minutes.
Thank you very much. Vice Chair, we know that this was basically the fault of the management. But what we want to know is where did the Fed go wrong? Where did the Fed go wrong? And specifically, did the Fed miss red flags or ignore warning signs that were brought to you by your staff months or even years before the collapse?
Thank you very much for the question. We do have in the supervisory record staff reaching out to the bank, highlighting these problems. As you noted, in the first instance, it's bank management's responsibility to fix those problems. They didn't do so.
Well, Vice Chair, is it true that the San Francisco Fed, which supervised Silicon Valley Bank, sent multiple warnings to the bank's management about the risk it was taking, including its substantial holdings of treasuries and other bonds that were steadily losing money as interest rates rose?
Yes, the supervisors pointed out to the banks that they were exposed to interest rate risk and liquidity risk, and that they didn't have the risk management in place to address those.
And
the bank failed to fix those problems.
And how often did Fed staff share with the Board of Governors that rising interest rates were threatening the finances of some banks, and in particularly the risk-taking at Silicon Valley banks?
My understanding is that the particular issue with Silicon Valley Bank did not rise to the level of the board until mid-February of this year.
And the other question is
The Board of Governors, I should say.
Why do you think that the full extent of the bank's vulnerability did not become apparent until it was too late, especially when the FDIC data was showing that SVB was doubling in size in 20 and 21, doubling in size within 12 months. Was that not a red flag?
No, I think you raised, I apologize, I didn't mean to cut you off there at the end. I think that one of the things we're looking at is that the way the Federal Reserve's regulations set up the structure for approach to supervision treated firms in the 50 to 100 billion range with lower levels of requirements and had a phase-in period for firms that got above the 100 billion line that meant that their transition into those higher standards took a long time. So by the time the group was actually looked at in an intense way by the group in the large and foreign banking organizations team, a lot of that growth and a lot of that activity had happened. And so in a sense, it was very late in the process. And that's one of the things we're looking at in our review.
Good. And I want you to know that I appreciate your recent announcement that a formal review into whether the Fed failed. It's good to admit failure. That is the first step for correcting the problem. And whether the Fed failed to properly oversee Silicon Valley Bank will take place, and more importantly, that it will be shared with us in the public. Is that true?
Yes, that's absolutely right. We thought that it's really important as a first principle of risk management for us to do our own self-assessment. We have a team of people working on that self-assessment who are not involved in the supervision of Silicon Valley Bank. We're going to make all of those findings and recommendations public on May 1st. And let me also say we welcome other outside reviews, as this body is doing today, and others will as well.
Thank you very much, Vice Chair.
The gentleman from Michigan, Mr. Huizenga, the chair of the Oversight Subcommittee, is recognized.
Thank you, Mr. Chairman. I'm going to quickly move ahead here. A loss in confidence in the banking system is a loss of confidence in regulators in many of our minds. Regulators seem to have had the tools at their disposal to prevent these failures from happening, but they seem to have missed that. We're going to be exploring that. As chairman of the Oversight and Investigation Subcommittee, I find it necessary to reiterate how important the congressional oversight is and that it's a constitutional authority that we have and, frankly, an obligation that we have to maintain the well-being of our system of government. Mr. Barr, you just had said it was appropriate for outsiders to do their independent reviews. That's what we are trying to do here today. You were authorized, though, on March 13 to do your report, correct? Who authorized that?
Chair Powell and I made...
Okay, that's all I need to know. Chair Powell authorized you?
Chair Powell and I jointly made the decision
Okay.
for me to proceed
Great.
with this.
Is it your understanding as well that under Dodd-Frank, anytime 13.3 is invoked and utilized, that the GAO is also supposed to do a report?
I'm not familiar with that precise provision, but it makes sense to me that GAO should do a review.
Okay. And do you know when GAO is going to be starting their report?
I respect the independence of the GAO
Okay.
and would suggest
Great.
that
Page 2 of your testimony, you said that the May report will include confidential supervisory information. Will you be providing that CSI to the GAO?
yes, consistent with
Okay.
normal practice.
Right? Well, we might have to unpack that a little bit. Will you also commit to me and this committee and to the chairman that you will provide this committee with all those same related confidential supervisory information needed to appropriately assess on our end what happened?
Yeah, the same information in the May 1st report will be available.
No, not in the report. You're giving if you're giving that supervisory information for the GAO to do their review, not before you review it yourself and decide what is appropriate and not appropriate. I thought you just said that you would be providing GAO with all of that data and information that you will be using to make your report. Is that correct?
We will make the information that we are using for the report available to you and to the GAO and.
Okay, so we have
and to
your
the public.
commitment that you are going to be providing us with all of that raw, confidential, supervisory information so that we can do our job.
The same information that we'd use for the GAO and for the public report.
I'm not looking for the report, though. I want to make sure we've got the information. I'm trying to make sure that our semantics
trying to
aren't
be
getting
careful
played.
we follow
Okay.
our-
I will
follow our rules.
accept the answer that you are going to give us the exact same information in a timely fashion that you are using for your report. Fair?
Yes.
Okay, all right. Mr. Gruenberg, I want to touch on the Treasury's commitment, I'm sorry, the FDIC, to look at what was going on there. The same question really is to you. Will you commit to providing the committee with all related confidential supervisory information that is needed for us to assess
Yes,
what is going on?
Congressman. One, I think you have the authority to compel that information. We'll be responsive to you.
Okay. Timely manner is the key watchword here. Between myself and the chairman, Chairman McHenry, we have a number of requests to all of you. Ms. Liang, want to touch on this. To obtain the information, FSOC was convened on both March 10, March 12, and March 24. Has FSOC met since March 24?
They have not met since March.
You have not, okay. So it was reported that Secretary Yellen convened these officials via video conference, is that correct?
Yes, I believe there
And you were part of that?
two FSOC meetings.
Okay, and you were part of that?
I was part of the second one. I was not part of the first one.
You were not part of the 10th, okay.
I was not. That was the evening, I believe, we announced. I was not part of the March
All right.
12th meeting.
Were minutes taken at those meetings?
By normal process, minutes would have been taken.
And will we have access to those minutes?
Yes, they are released according to.
Before they're released, because we only have minutes from December 22. There is nothing that has been released publicly since December 22.
That is correct. I believe the process is minutes are released following the next formally scheduled FSOC meeting.
Only if
But
formally
we can-
scheduled.
We can come back to you on that, when they will be released.
So we have to wait till the next formally scheduled time to get those minutes.
I understand
Gentleman's time
that's
has
the
expired.
process, but
We'll be
can come
following
back
up
to
in
you.
writing. Thank you.
We expect a written response for that, Undersecretary. We'll now recognize Mr. Lynch of Massachusetts for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Member, for holding this hearing. I want to follow up on Ms. Waters' line of questioning. Prior to its collapse, Silicon Valley Bank was a major lender and investor in low and moderate income housing in Massachusetts, in my district, in large part because it acquired the Boston Private Bank and Trust Company back in 2021. So that includes not only deposits, but construction financing, permanent financing, mortgage lending for low and moderate income home buyers, equity investments, and direct purchase of tax-exempt bonds for affordable housing development. So right now, I've got 18 affordable housing developments in my district and on the outskirts of my district, currently in construction in Massachusetts, and they depend on the fulfillment of outstanding debt and equity commitments that were made by Silicon Valley Bank. So these developments, and this is the back of the envelope, I'm sure there are more, but I have 754 homes, including 702 affordable homes for residents with low incomes, and 118 homes for residents with extremely low incomes, as well as workforce housing. So while the vast majority, here's the thing, while the vast majority of high net worth investors and depositors at Silicon Valley Bank have been held harmless, they've been rescued. The First Citizen Assumption Agreement is completely silent on the status of these low-income victims. And that is a problem. That flies in the face of your mission and mine. And so, Mr. Gruenberg, now, and I appreciate all three of you and the work. You worked quickly once you saw the problem. And I find great fault with the reckless management on the part of Silicon Valley Bank in that they concentrated so much risk and there was an absence of meaningful risk management. But we have a problem. And while the bank crisis might be over, it's not over in my district with all these families, all these low-income families that are struggling. You know, I got cities like Brockton, Massachusetts. We got a great mayor there doing a wonderful job, and they're all going in the right direction, and as well as Boston and Quincy and others. But we need help. We need to resolve this. So, Mr. Gruenberg, I need a commitment from you, sir, that you need to come to Brockton. You need to come to Brockton in my district, and we need to work this through so that we provide the kind of protection for low-income families, a lot of them families of color, many first, they're first-generation immigrants, and, they need help. And I think you and I need to be there, and I'll get my mayors together and these 18 affordable housing development managers, and we'll try to get this done. But can I get your commitment? Any thoughts on that?
Yeah, Congressman, I'd be glad to do that and follow up with you as First Citizens takes over, is in a position to continue to serve the customers of the former institution and work with you in regard to the community issues you just described.
That's great. I'm very happy to hear that. There's something new and different, though, in this collapse. There was a concentration of risk on the part of Silicon Valley Bank. They catered to early-stage startups which have a high rate of failure in the first place. They're very skittish, so those aren't core deposits that are going to stay through any period of unsettled economy. And then on top of that, you have panic that is driven by social media in many cases. You had venture capitalist firms telling their clients at that bank to get the heck out. So the speed at which this happened was a matter of hours. And again, I commend you on the speed at which you acted. But is there something more that we need to be doing now because of the velocity of money? People can move their money out like that. And are we equipped? The FDIC has a long and strong history, but is something new and different needed to protect us from that phenomenon?
Congressman, I think that's an important question to ask. I think we are dealing with a different environment, and the point you raise in terms of how quickly money can move, what the technology enables now that exceeds what's occurred in the past is a new risk factor that we have to think about.
I would ask the panel to all respond to the gentleman in written form about that very, very important subject. I will now recognize Ms. Wagner of Missouri for 5 minutes.
Hi, thank you, Mr. Chairman. And Vice Chair Barr, we're going to go very quickly here, so I would like some succinct, brief answers if we could. Vice Chair Barr, referring specifically to Federal Reserve supervisors, do you know how many citations, specifically the matters requiring attention, MRAs, and matters requiring immediate attention, MRIAs, that were issued to Silicon Valley Bank regarding its management of liquidity risk? Microphone and a number. Do you know how many?
In November 2021, there were 6 MRAs and MRIs on liquidity. In the in the fall of 2022, there was an additional MRA on interest rate risk modeling. I think I misidentified inadvertently yesterday as an MRIA, but as an MRA.
That's fine. I don't need you to go through all of them. We've got 6, maybe 7 of these citations that were given. Yesterday, you were asked about an MRIA that was issued in the fall of 2022. You stated that the MRIA was issued, quote, based on the inaccuracies of their interest rate risk modeling. Essentially, the risk model was not aligned with reality. This is your quote.
Yes.
Did the supervisors provide the bank a timeline to remediate this misalignment? Since changing an interest rate risk assessment model seems to be something that could be done very quickly.
Yes, my understanding that there were time limits associated with each of these MRAs and MRAs, but I don't have the information.
Really?
precisely
Okay, well,
the time.
clearly those alerts were ignored at the bank. Why didn't the Fed consider escalating any of these issues into a cease and desist order or other formal enforcement action against the bank to require senior management and the board of directors to remediate these serious deficiencies?
I think you raise a fair point, and we will be looking into that.
I certainly hope so. Vice Chair Barr, in your testimony you stated, quote, "The failure of SVB illustrates the need to move forward with our work to improve the resilience of the banking system. For example, it is critical that we propose and implement the Basel III endgame reforms, which will better reflect trading and operational risks in our measure of banks' capital requirement needs." Sir, I strongly disagree. These reforms will result in additional costs on consumers, on businesses, and investors. I'm gonna go real quickly here. Was trading risk the reason SVB had almost 94% of its deposits uninsured?
No.
Was trading risk the reason SVB did not have a risk officer for nearly 9 months last year?
I do not believe that that was the focus of why there was not a credit
So,
risk officer.
no, trading risk was not the reason. Was trading risk the reason SVB had 51% of its deposits in the tech industry? Yes or no?
Not to my knowledge.
You know, I fail to see how SVB illustrates a need to implement Basel endgame reforms, particularly as it relates to trading risks. Can you show how trading risk directly resulted in SVB failure? Or, sir, are you just looking for any reason, correlated or not, to justify increasing capital requirements for our banks?
I think it's really quite important that we strengthen capital and liquidity requirements in the system. It's something I've been working on since arriving at the board in July. And I think that the work that we're going to do, that we will propose through notice and comment rulemaking, will make the financial system safer and sounder. That reduced risks that firms such as SVB in the future
You have stated
might cause
that yesterday that our banks are well capitalized, did you not?
Yes, I have been consisting in saying that both that the system is strong, but that also we need to think about stronger capital rules, and I think that's appropriate given the
Well, we're
risks.
going to have a hearty give and take on this. You know, I want to say this in closing. Despite U.S. regulators having clear knowledge of insufficient risk management, it seems that the examiners and your supervisors were asleep at the wheel, while signs that Silicon Valley Bank was heading towards a collapse were staring them right in the face for many, many months. Vice Chair Barr, I look forward to the release of your review of the supervision and regulations of Silicon Valley Bank so we can dig in some more on May 1st, and I hope that it provides more clarity to the events leading up to these bank failures. I thank you, and I yield back the balance of my time, Mr. Chairman.
We'll now recognize Mr. Green of Texas for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member, the witnesses for appearing. Witnesses, you have all made the case for mismanagement at Silicon Valley. If you disagree with this statement, please extend a hand into the air. Let the record reflect that all witnesses agree that mismanagement was occurring. I have before me a news article from what is perceived to be by many a reliable source, CNBC. The style of the article is, that would be the title, the style is Silicon Valley Bank employees receive bonuses hours before government takeover. Hours before government takeover bonuses. It's also alleged by other sources that these bonuses could exceed $100,000. Mr. Gruenberg, is it true that hours before the takeover of the bank, before it was seized, that bonuses were accorded employees?
Congressman, since we weren't the supervisor, I wouldn't have that direct information. I'm sure we could get it for you, or the Federal Reserve could provide it.
I welcome the intelligence from the Federal Reserve.
But if I could just make an additional point, which is the FDIC is under a legal obligation after the failure of Silicon Valley to conduct an investigation of the conduct of the board and the management of the institution. And if misconduct occurred, we do have authority to impose civil penalties, including civil monetary penalties, restitution, and to bar individuals from the business of banking.
Thank
So
you.
we do have some significant authorities and responsibilities.
Thank you. I yield to the FDIC. Excuse me, to the Fed.
Thank you very much, Representative Green. The board also has the authority.
Without the authority right now, just tell me, were there bonuses given out hours before the bank was seized?
I have seen reporting of that, but I'm still trying to chase down the facts. Our enforcement team has the ability to go after actions against individuals.
So you're saying you do not know, but you have heard that this is the case?
Yes, I do not have the supervisory record of that to know, but I've seen reporting of that, and we're looking into it.
For the moment, let's just assume that Bank X hands out bonuses. Management has failed to do its job. Do you have the inherent or accorded or statutory power to claw back those bonuses?
We have the ability to pursue actions for individuals who violated the law.
May I kindly ask about clawback of bonuses? Can you claw back those bonuses?
Under our authority, if there are violations of the law or unsafe or unsound practices or any breach of fiduciary duty, we can get restitution, we can get civil money penalties, and we can have a
should I
prohibition
assume
of
that your answer is no, you do not have the authority to claw back those bonuses?
We don't have generalized clawback authority.
You do not. All right, I see a hand raised. Mr. Gruenberg, please.
Just to try to respond directly to the question, we do not have explicit the FDIC does not have explicit clawback authority under the Federal Deposit Insurance Act. We have that authority under the Dodd-Frank Act in regard to failures under Title II, but we do not have that under the Federal Deposit Insurance Act. So in considering additional authorities that Congress might provide, that might be something worth considering.
Thank you, Mr. Gruenberg, because that's exactly where I'm going. We live in a world where it's not enough for things to be right, they must also look right. And it just doesn't look right for hours before the bank is seized, bonuses to be accorded employees, and some of these bonuses total more than $100,000.
Gentleman's time has expired. We'll now
Thank you.
recognize the Chair of the Financial Institutions Subcommittee, Mr. Barr.
Thank you, Mr. Chairman and Ranking Member, for holding this important hearing. And Vice Chairman Barr, true or false, Silicon Valley Bank experienced rapid asset growth in a short period of time?
Yes, that's correct.
Silicon Valley's rapid growth was fueled by an extremely high concentration of deposits from a single sector.
Yes, that's correct.
Silicon Valley Bank became overdependent on an extremely high percentage of uninsured deposits.
Yes, that's correct.
Silicon Valley Bank failed to hedge the risk of holding long-duration securities in a rising interest rate environment.
My understanding is at one point they had hedges, and those were not in place at the time they failed.
And that was apparent to the Fed.
Yes, it was apparent to the Federal Reserve.
Silicon Valley Bank had no chief risk officer for 8 months before its collapse.
Yes, that is correct.
Was the San Francisco Fed unaware of any of these basic facts in the months leading up to its failure on March 9th?
Not to my knowledge.
So nothing in the existing regulatory framework concealed
these basic facts from the San Francisco Fed, which had responsibility of supervising this bank?
The regulatory structure doesn't conceal facts. It may have an effect on how supervisors act with respect to those facts.
True or false, Silicon Valley Bank was subject to enhanced prudential standards under Dodd-Frank as amended by the 2018 bipartisan regulatory relief law.
The Federal Reserve supervisory structure did not apply most enhanced prudential standards to the firm. It did have some enhanced prudential standards once it became subject to those standards after it passed the average at the 100 billion level.
Before it passed that $200 billion threshold, when it passed the $100 billion threshold, it was under 2155, the bipartisan regulatory relief law, under Section 401A1C of that law, the Fed could have applied enhanced prudential standards to Silicon Valley Bank. Is that correct?
Under the 2019 rules that the Federal Reserve put in place, most enhanced prudential standards did not apply to the firm.
Well, wait a minute. I don't know about that, because under 401A1C of that law, the Fed, by order or rule, could apply enhanced prudential standards to banks not above $200 billion, but above $100 billion in assets on a one-off basis.
Yes, the legislation provided the Federal Reserve with ample discretion. The way that discretion was implemented in 2019 was with a rule, and that rule provided
But in
some
order,
enhanced standards.
but by order, and reclaiming my time, Vice Chair, by order, the Fed could have applied enhanced prudential standards before the bank reached the size it did by February of 2023. My point is, it doesn't seem appropriate to change the tailoring rules for all banks to account for a lapse in supervision by the Fed and the inability of the Fed to deploy enhanced prudential standards to firms when it's currently able to do so under existing law. And Mr. Barr, as you and I have discussed, and as we agree, we need to preserve the diversity of the financial ecosystem here. The Fed had all the existing tools it needed to supervise this bank and apply those enhanced prudential standards. I think pushing a one-size-fits-all or reimposing a one-size-fits-all regulatory regime on community and regional banks, especially regional banks under distress right now, would result in fewer of those institutions, more consolidation, and less competition for too-big-to-fail banks. Mr. Director Gruenberg, the vast majority of community banks in my district are well-managed, and they actually understand how to manage interest rate risk in a rising interest rate environment. And since the failure of Silicon Valley Bank, those Kentucky banks and their customers have been asking me why they should have to pay an assessment for your rescue of Silicon Valley Bank with a 100% guarantee of deposits of largely wealthy, sophisticated depositors at Silicon Valley Bank, some of whom apparently cared more about the bank's commitment to environmental sustainability than their capability to be good stewards of their deposits. I think this is a legitimate question. And I also think it's a good question whether invoking the systemic risk exception to the least cost resolution mandate under the Act was in fact the least cost solution. After all, your decision to cover all of the uninsured deposits cost the Deposit Insurance Fund an estimated $20 billion. Will you commit to using your authority under 12 U.S.C. 1817 to establish separate risk-based assessment systems for large and small members of the Deposit Insurance Fund so that these well-managed banks don't have to bail out Silicon Valley Bank?
Certainly willing to consider that, Congressman, and as I indicated, we are going to be preparing a comprehensive review of the deposit insurance system, so we'll come back to you and glad to engage with you.
Gentleman's time has
Thank you, I yield.
expired. We'll now go to Mr. Himes of Connecticut for 5 minutes.
Thank you, Mr. Chairman. It's interesting to me to listen to my friends on the other side of the aisle who ordinarily spend all of their time trying to defund, destroy, and denigrate your organizations, now hold you entirely responsible for where we find ourselves today, despite activities within the bank that I think we all agree, and Mr. Barr, you have said were on the verge of outrageous. So I'd like to begin by thanking all of you and your organizations for the intense and sleepless actions you took beginning on March 9th. I don't know if you acted perfectly, and you don't know if you acted perfectly, but we all know that today the financial system appears to be stabilized, and we certainly know that Congress is not lighting itself on fire, crafting a massive publicly funded bailout as it was in the fall of 2008. I hope that we've dispensed with the absurdity that it was Silicon Valley's woke activities that drove this failure. And while I don't necessarily agree, Mr. Barr, with your predecessor's statement that blaming the bipartisan 2018 reform law is so nonsensical it isn't even wrong, the truth is that Silicon Valley Bank was crawling with supervisors and regulators who had been raising the alarm for a long time. And that's what's interesting to me about this whole episode. It was not a surprise. It wasn't a surprise to the regulators and supervisors who had been raising those alarms for years. It shouldn't have been a surprise to the management team who had been the target of those alarms. By the way, just as a side note, it was a surprise to the Wall Street research analysts who were paid very good money to evaluate Silicon Valley Bank. 24 Wall Street analysts covered Silicon Valley Bank. 11 had buy ratings on it, 11 had hold ratings on it. Only one analyst rated it a sell. More seriously, the credit rating agency, S&P Global, rated Silicon Valley investment grade right up until March 10th when it announced that it expected a bankruptcy. There's an uncomfortable echo of 2008. By the way, Mr. Chairman, I'd like to insert for the record unanimous consent, a remarkable article by Professor Raj Gopal of the Columbia Business School, which elaborates many of these points that I'm making.
Without objection.
The facts have been put out there pretty comprehensively. In 2021, 2 years ago, the Fed review results in the finding of serious weaknesses, the issuance of 6 matters requiring attention and 1 matter requiring immediate attention. July of 2022, the full supervision review rates the bank deficient. That's 7 to 8 months before March's meltdown. Early 2023, there's a horizontal review. Again, the word deficient. So, and by the way, that's complicated for most people to understand. Here's something that's not complicated for people to understand. As far as I can tell, Silicon Valley Bank had precisely one individual who was a banker on their board, Mr. Thomas King. The risk committee of this bank, which tripled in size in 2 years, had no one. The risk committee had no one on the committee with any significant banking experience. So, Mr. Barr, I'm going to put you in an uncomfortable position and say, clearly what we have here is a gap of time and a failure of action between the deficiency rating in July of 2022 and the meltdown in March. That's a long period of time. So I'm going to ask you for ideas, not necessarily good ideas. I understand that you're going to be uncomfortable to make recommendations, but clearly we need to tighten up the process by which good things happen after a finding of deficiency. So should that be left in your regulator's discretion, or should we act in such a way as to make actions mandatory subsequent to a deficiency rating?
It's a great question you raise, and one that I think is appropriate for reviewing both by you and by us. I think that we need to put in place risk mitigants and incentives that are much stronger, faster in the supervisory process. That's one of the things that we'll be looking at in the review. But I do think that in instances like this, where it is such a fundamental issue, we need to have risk mitigants in place that are ordered by the supervisors quickly.
So I'm just going to make this observation as I run out of time. As we all saw, one of the problems here, and one of the new things here, were the chat rooms and the speed by which deposits could be withdrawn. And billions of dollars went out the door because of these devices. So I'm not convinced that giving humans who operate in human time additional authority is going to do the trick here. I think we need to think about automatic mechanisms, and that may require statutory change, automatic mechanisms that when a finding of deficiency or other adverse observations have been made, kick in automatically, perhaps after some cure period. But this was a meltdown that happened at the speed of light, and humans with discretion is not going to solve it in the future.
Gentleman's time has expired. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm going to repeat myself a little bit, what you've heard today, but when I talk to community banks in my district, and in full disclosure, I'm a car dealer, and I talk to them a lot, and I owe them a lot of money. One of their top worries right now is being left to foot the bill for the failures of Silicon Valley Bank and Signature Bank. Community banks, which most of us live by, should not be liable to pay for the rescue of larger banks that gambled and made a risky bet. So community banks are relied upon Main Street, America, to be a lifeline and provide crucial banking services to small businesses. So these smaller banks, which we all need to have, are some of the most trusted institutions in the financial industry. So, Mr. Gruenberg, you talked about it before, but could you elaborate if smaller community banks in Texas, where I'm from, will be left responsible for bailing out the failed banks in California and New York, which we don't even know where they are?
Thank you, Congressman. I'm keenly sensitive to the concern. Let me just say, under the law, the FDIC is required to impose a special assessment on the banking industry to recover any cost to the Deposit Insurance Fund from covering these uninsured deposits. And we have to do that by a notice and comment public rulemaking, which we're going to do in May. And just to be clear, the law gives the FDIC authority to consider the types of entities that benefit from any action taken or assistance provided, so that the FDIC does have discretion. And let me just say, without forecasting what our board is going to vote, we're going to be keenly sensitive to the impact on community banks.
Take a look at it, because we all know that what they'll do is pass the cost on to someone like me. The Federal Reserve was supposed to be the primary supervisor over Silicon Valley Bank, but from all we've seen and heard today, they failed to do their job, and it's been reported that Silicon Valley's bank risk practices were on the Federal Reserve's radar. We've talked about that for over a year. In 2022 alone, Fed supervisors issued 3 findings on SFB's ineffective board oversight, weakness in their risk management, and flaws with the bank's internal audit function. So it should raise major concerns that the Federal Reserve, who is tasked with regulating and overseeing banks, knew about Silicon Valley's risky practices far more than a year and failed to take any corrective action. Now, Mr. Barr, what actions, if any, did the Federal Reserve take, and you talked a little bit about this, after issuing those risk findings, and how did the Fed Reserve become so complacent on its supervisory role and miss these warning signs? And I think that's what people across America really want to know.
Thank you very much for the question. My understanding is that the supervisors identified the issues, they brought them to management's attention. The response clearly was not an effective response. Bank managers failed to manage the firm in an appropriate way. They didn't manage their interest rate risk and their liquidity risk well, even though it was pointed out by the regulators. And I do think it calls for a heightened need for more aggressive supervisory action to take care of these problems.
But you all missed it too.
I'm sorry?
You missed it too.
The supervisory staff were aware of the underlying issues. I think all of us were caught incredibly off guard by the massive bank run that occurred when it did on March 9th and 10th. The scale and speed of that, $42 billion going out the door Thursday afternoon. It was expected by the bank that $100 billion more would go out the next day. That's just an extraordinary scale and speed of a run that not anything I had ever seen before.
Okay, out of all the banking supervisors, I would expect the Federal Reserve, and most of us would, to be the most aware of the impacts increased with rate hikes would have on the value of securities for banks. However, the Fed has stress tests, which we've talked about, which are conducted to determine how large domestic banks would perform under hypothetical and stable economic scenarios, currently does not test for the problems that caused Silicon Valley Bank to fail. SFB failed because of inflation, rapid increases in interest rates, and loss in value of government bonds. So even if SFB had been subject to testing, it would not have led to the changes that could have prevented their failure, because the Federal Reserve is asking the wrong questions and not running scenarios that ultimately led to SFB's downfall. So we'll correct, Mr. Barr, how can the American people trust the Federal Reserve if you are not testing for all scenarios? How was the Federal Reserve so far off? That is a question that everyone asks again.
I think that the Federal Reserve should use multiple scenarios. That's one of the reasons why I proposed that for this year's test. It includes a rising interest rate environment for the trading book. Yeah. I think multiple scenarios makes a ton of sense and should be done.
You know, that saying, they can get it right 100 times. You got to get it right once. So you got one crack at it. So thank you very much.
Gentleman's time has expired. We now recognize the ranking member of the Digital Asset Subcommittee, Mr. Foster, Illinois, for 5 minutes.
Thank you. As you know, 12 years ago during Dodd-Frank, a number of us put a lot of effort into specifically authorizing U.S. bank regulators to put contingent capital requirements into the capital stack of large banks. These can sort of be thought of as a sort of privately funded insurance policies that large banks are forced to carry that pays out if a bank gets into trouble and automatically injects capital into a struggling but not yet failed bank. Now, for the last 12 years, U.S. bank regulators have completely ignored this authorization from Congress, which I have complained about in numerous hearings. But in the last 12 years, European bank regulators and others have used contingent capital successfully. And so now I believe that we have a lot to learn about two side-by-side bank failures. First, Silicon Valley Bank, a large bank by some measure, but with total assets less than 1% of U.S. GDP, and Credit Suisse, with total assets greater than 100% of Swiss GDP, too big to fail by any metric. Now, when a couple of weekends back, the U.S. banking regulators tried to find someone to buy SVB, they failed. The result was potential systemic risk and emergency intervention that has, by regulators, that's risked abandonment of a lot of market discipline and market chaos. And the Deposit Insurance Fund and eventually banks and their customers must take the hit. But when Swiss regulators tried to find a partner to buy out Credit Suisse, they succeeded. And at this point, it looks likely that the Swiss taxpayer and their DIF will be off the hook for this giant bank's failure. And the difference was contingent capital. Because when Credit Suisse got into serious trouble, their contingent capital triggered and injected $17 billion of equity into Credit Suisse. This was absolutely essential to finding a buyer for Credit Suisse, since, as you know, Credit Suisse was bought for about $3 billion, but only after the $17 billion of capital injection by their contingent capital instruments. So the Swiss contingent capital succeeded at its two design objectives. First, to prevent contagion, and secondly, to keep the Swiss taxpayer off the hook for the failure of a truly giant bank. Now, if Silicon Valley Bank had been forced to carry an appropriate amount of contingent capital, then capital would have been automatically injected sometime probably Friday at the latest. And it was very likely that a buyer could have been found over the weekend as well. And we would not be having this hearing today. In fact, it's possible that they would not have gotten in trouble in the first place, since Silicon Valley Bank would have had to answer not only to the regulators, but to the bond markets for their risky practices. When they went through their gigantic growth spurt, they would have had to issue a lot of contingent capital instruments, and I'm pretty confident that one of the wizards in the bond market would have said, this is interesting. This bank is, has very flighty deposits and essentially no risk management in place. Maybe we should charge a pretty big risk premium, and the markets might have detected that. So my question is this, Vice Chair Barr, as part of your holistic review of bank capital requirements, will you commit to finally seriously considering contingent capital requirements in the capital stacks of large banks?
Thank you very much for your question, and I very much appreciated our conversations over the years on this very question of contingent capital instruments. Both the FDIC and we have issued an advance notice of proposed rulemaking of a different type of contingent instrument, a gone concern capital instrument that would be required for large banks. But I think it does make sense to consider alternative options, and I'd be happy to continue the conversations with you about that.
Okay, and I would specifically appreciate it if your analysis included a counterfactual analysis of how much better off we would have been if regulators had listened to Congress and included contingent capital requirements into the capital stacks of these banks, because I think there's a lot to be learned from just the counterfactual analysis. I'd like to just close out by finishing up a little bit with questions about the non-responsiveness of SVB management to the early warnings they got. Is there leverage that we can provide you? An obvious one is to say all of these matters requiring immediate attention and so on are private. And what, for example, if they had to become public after 60 days if they were not resolved? Would that have lit a fire under the chair of the management? Are there other things? For example, you could say any management that had an ongoing a pending MR, matters requiring immediate attention, we'd simply put all the bonuses in escrow. That would almost certainly get their attention. So are there, if you could include these sort of ideas, I'd appreciate it.
If you'd submit for the record, Mr. Gruenberg, Mr. Barr. Now recognize Mr. Emmer of Minnesota for 5 minutes.
Thank you, Chairman McHenry. Thanks for holding this important hearing today. The collapse of 3 regional banks over the course of 2 weeks is directly related to failed Democrat policies. Record inflation as a result of reckless government spending led to historic interest rates that banks were not ready to manage. It appears financial regulators were not appropriately communicating financial risks of the high-rate economy with banks in their supervisory capacity, and this administration's political attack, quite frankly, from the highest levels of our government on the digital asset industry, which, by the way, had nothing to do with causing the runs, sparked fear, leading to bank runs at Silvergate, Silicon Valley Bank, and apparently Signature, bringing these core issues plaguing our economy and the broader banking sector to the surface. Let's not be fooled. Providing financial services to legal businesses in the U.S. should not be risky. But this past month has proven that the mismanagement of our monetary policy has apparently made it risky to put dollars in a bank. Mr. Gruenberg, will the FDIC sell off Signature's deposits from digital asset businesses? Yes or no?
We're returning those deposits to the depositors, Congressman.
So, okay. Does the FDIC plan to sell the intellectual property for Signet?
I believe that's already been sold out of the Bridge Institution, Congressman.
All right, we would like to see that information. Will you commit that a bank that buys Signet will be able to use it to facilitate 24/7 access to the banking system for digital asset companies?
I'm happy to look into that. I don't know who the buyer was, but be glad to look into it and follow up with you in regard.
You're not going to block the buyer from doing 24/7 banking for digital asset companies, is that correct?
If that's the nature of the acquisition, yes.
And will you commit that a bank that buys Signet, or the bank that did, will be able to onboard new digital asset customers?
Again, I'd like to look into the transaction, but I'd be glad to follow up with you in regard to it.
When the FDIC sold off Silicon Valley Bank's deposits to First Citizens, did that include deposits from any digital asset firms or VCs in the digital asset space?
I believe all of the deposits from the failed Silicon Valley Bank were transferred to First Citizens.
Including the digital?
All of them, yes.
Were all of SVB's deposits from digital asset businesses, again, transferred to Citizens? That's what you're saying?
My understanding, First Citizens assumed all the deposits of the failed.
Has the FDIC ever communicated implicitly or explicitly, sir, to any banks that their supervision will be more onerous in any way if they take on new or maintain existing digital asset clients?
No.
Thank you. The FDIC estimates that resolving Signature Bank is going to lead to a $2.5 billion loss to the Deposit Insurance Fund, and resolving Silicon Valley will lead to a $20 billion loss to the Deposit Insurance Fund. When the FDIC sold Signature, it had the effect of closing Signet, which is an innovative payment system that facilitated 24/7 access to banking services. Frankly, a private sector innovation that apparently will be rivaled by FedNow. Signet is intellectual property that has significant value, so I do want to see that sale. Chairman Gruenberg, when managing the resolution of any failed bank, the FDIC is statutorily required to do so using the least costly resolution option, thereby minimizing losses to the Deposit Insurance Fund, which is replenished by the banks through fees that are indirectly passed on to everyday Americans with bank accounts. I'm concerned that the FDIC has deviated from its statutory requirement to minimize costs here and instead has opted to pursue a lazy and destructive regulatory campaign to in fact oust digital asset opportunities from the United States. No bank is designed to survive manufactured bank runs, and in analyzing what caused this fiasco in the first place, many signs point right back to you and the FDIC, this administration, and certain reckless Democrat senators. I want to thank you again for coming today, and I appreciate a response to my March 15th letter, because to me it's still clear that we have a lot of questions that need answers. And with that, Mr. Chair, I yield back.
Gentleman yields back. The ranking member of the National Security Subcommittee, Mrs. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Chair. Mr. Gruenberg, we know that both SVB and Signature had very high proportions of uninsured deposits, somewhere between 90 and 95%. Can you share with us or explain to us what the typical ratio is for your average bank and how this factor played into the bank run that we witnessed on March 9th?
Thank you, Congresswoman. It's an important question. I think fair to say these two institutions were outliers in terms of their exceptional concentration of uninsured deposits, both around 90%. In the regional bank space, between 100 and 5 or 600 billion, I think it's generally in the 40% category. So these two institutions were outliers, and it was a significant part of the liquidity risk on their balance sheets.
And would you say that this high proportion of uninsured deposits left the bank more susceptible to this run?
Yes, it was, I think.
Let me also have a follow-up question to you. We've heard many ideas proposed about modifying the $250,000, and we know in, I think it was 2008, with the Emergency Economic Stabilization Act, we went from 100,000 to 250,000. So, for example, what about temporarily insuring all deposits, increasing a limit to 500,000 or $1 million, ensuring all deposits for small and mid-sized firms, or limiting it for the largest financial institutions? What are your thoughts on some of these proposals?
Well, as you understand, Congresswoman, the coverage for deposit insurance is statutorily set at $250,000 per account. So to adjust it would require legislative change. And as I indicated earlier, the FDIC is undertaking a comprehensive review of our deposit insurance system, and we'll come back with a report that we'll release publicly outlining policy considerations for.
So is this one of them? And you can weigh in also, Mr. Barr or Ms. Liang, on, I mean, you're experts, you're testifying here on your opinion. I understand that it's statutory and requires it to come back here, and certainly, as you know, we've changed many things over the years in rooms like this. So to the public, I don't want you to think that this may be as far-fetched. We had large banks when we had too big to fail, and we're certainly more than $50 billion now as we had legislative ways to change it. So what are your thoughts on increasing? That's one of the number one things I'm getting from constituents. You know, it was just in 2008, it was 100,000. We made the change then through an emergency act. What now?
Congresswoman, I look forward, the FDIC, as Chairman Gruenberg mentioned, is doing a review of the deposit.
Would you
insurance
support
fund.
an increase?
I would support a study and proposals for reform if needed. The rise in uninsured deposits, it has been increasing over the years.
Okay, only because my time is running out. Mr. Barr, and the next question is going to be for you, so.
We'd be happy to work with you on thinking through that. I think taking a step back, the important thing is that our banking system is sound and resilient.
Okay.
The actions the regulators took demonstrate that deposits are safe, and we'd love to continue the conversation with you.
Okay, I'm glad you said sound and resilient. In your opening testimony, you said the same thing, that you thought banking was sound. You also used words like strengthening the public confidence, or paraphrasing it. I'm from Ohio, and the public pension fund nationwide, as you know, lost millions of dollars that were invested in SVB and Signature. In my home state of Ohio, the state teachers' retirement system took the biggest hit, with some $27 million that was invested in SVB. Representing, I know, maybe only 3 or 4% of the fund's total portfolio, but I'm concerned about reports that the CEO of SVB unloaded millions of stock in the days and weeks leading to the collapse. I know that we're expecting a report on the Fed's investigation of SVB. be in May, but is there anything you can share today regarding the bank's executive management? And, okay, thank you, and thank you, Mr. Chairman.
If the panel would respond in writing to Mrs. Beatty. We'll now recognize the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Mr. Chairman, for holding this important hearing. And Chairman Gruenberg, I'd like to discuss, and I know my colleague, Congressman Williams, Chairman of the Small Business Committee, has focused on this before, but I'd like to discuss the special assessment fee that will be used to cover the losses from the uninsured deposits. You've explained the proposed rulemaking for the special assessment will occur in May of this year. And while you're thinking about that, be thinking about a discussion of the flexibility the FDIC has during the rulemaking to ensure that our small community banks don't disproportionately carry the burden. Being one of the older members of this committee, I've been around long enough to have observed firsthand several banking crises. 1982, I was getting ready for my final semester at Oklahoma State when a little institution in Oklahoma City called Penn Square went down and took First Continental Illinois of Chicago down with it, a bank from the, 1840s or 50s. Took First Seattle down with them too. Now, FDIC and the regulators responded in the appropriate fashion and addressed that. But it was a combination of collapse in the oil and gas industry and in production agriculture. And the chain reaction in my great state was the slaughter of community banks. The slaughter. There was no quarter given to those folks. They were locked up, chopped up, sold out. The legislature met in the middle of the night to authorize not just one town, one physical location, one charter banking, but we went to branch banking because it was all falling down on us. The people who I represent were brand new, young banking men and women 40 years ago when they saw how community banks were handled in my state. They weren't Penn Square, they weren't First Continental, they weren't Seafirst. They're now my most senior bankers 40 years later. And they're looking at this situation and they're saying to me, we've been the least problematic of any sector in the financial services industry for decades to the regulators and the FDIC. But yet, in every crisis since then, we've been kind of the orphans. And this time they're saying, we were wiped out as an industry 40 years ago, but now we're going to get a special assessment to pay to fund for the mistakes of the most sophisticated institutions, the biggest institutions. Can you tell me how it's possible when this special assessment fee process is completed that my community bankers aren't going to wind up disproportionately paying for the mistakes and the folderol of the biggest institutions in the country? Or are they just be prepared to be the goat one more time?
Critically important question, Congressman, keenly sensitive to it. We have discretion under the law. We have to act pursuant to a notice and comment rulemaking. Anything we put out will be subject to public comment, but we have discretion, as I indicated earlier, and will repeat, we'll be keenly sensitive to the impact on community. I don't want to front run my board. We're going to have to do a notice and comment rulemaking, but I hear you and keenly sensitive to the point you raised.
I would just offer once again the observation. The perspective of my community bankers is, if you're big enough, we've now given you an emphatic protection. It appears with what we've done in the last few months, if you're in that intermediate range, we're going to protect you. But if you're the little bankers, the little guys and ladies out there meeting the day-to-day capital needs, you're going to be the one to pick up the bill. And I kind of appreciate their point, having lived through 40 years of these experiences in my great state. Shifting to another question. As has been discussed today, Treasury approved the systematic risk designation on March 12th upon the recommendation of the Federal Reserve and FDIC.
I want to discuss for a little bit the process leading up to this. I think it's important that we have a clear picture of how the regulators made this designation, and not just in theory, but in practice. So, Vice Chair Barr, could you provide insight into which regulator acted first in proposing that uninsured deposits be protected? These are the kind of questions I'm getting back home. And while you're thinking about that, were there discussions between the FDIC and Fed prior to the respective board meetings?
I see my time has expired, but I'm happy to follow up with you.
Well, you can go ahead and answer it.
I bet somebody will
really
give you
heightened
time.
right now and interested. Plus, we're close to getting a little break here, so.
I'm happy to. So,
Please, thank you.
We were in conversations, all three agencies, over the course of that weekend, trying to think through what the potential ramifications might be in the financial system. It was a very difficult judgment to make. It involves, of course, information we're getting from around the system, from hearing from community bankers.
If the gentleman will give a timeline of those conversations between the two agencies and the two principals of the FDIC and the Fed for a written statement. Gentleman's time has expired. We'll now go to Mr. Vargas of California for 5 minutes.
Thank you very much, Mr. Chairman and Ranking Member. I guess I'm looking at this a little bit differently, and that is we could have been here today looking at the collapse of hundreds of banks. We could have been here today trying to figure out how to stop the contagion. But instead, we're here looking at significant banks with significant problems. And I think that that's important. But I think what's more important is that everyone worked together. We certainly have our ideological differences, and they're significant. I mean, I heard right away it was Biden's fault, from some members, and I could easily say it was, hell no, it was Trump's fault. But the truth of the matter is that, we're out of our ideological silos and trying to figure out practical solutions. I want to thank the chair. I think the chair worked very, very hard on this, and I think that he probably was a little uncomfortable with his ideologues on his side, maybe, but I think he did a fabulous job, and I want to thank him publicly. I think the ranking member did the same. I think they worked very, very closely together to try to figure out, what can we do as a legislature to make sure that there's not contagion. I want to thank all of you. I think all of you acted very honorably, nobly as you should have, to try to figure out what's the solution here. And again, I appreciate that deeply. Again, we could be here talking about a disaster, an unmitigated disaster. I was worried about that. I mean, I worry about these things, and we're not. Instead, we're looking at these important issues. So now that we are, and I got that off my chest, I do want to ask you, Mr. Barr, you were quoted quite extensively for saying, let me get it correctly here, I don't want to put words in your mouth. To begin, SVB's failure is a textbook case of mismanagement. Was that a correct quote?
Yes.
Well, then why, the natural question is, to begin, why wasn't there a textbook case of enforcement?
I think that's a good question, one we're exploring very much. The supervisors looking at the bank identified the problems with the bank. And the question is, did they identify them with enough level of urgency? Did they escalate appropriately? And I think that's what is an incredibly fair question we're looking at carefully. I expect that we're going to find that we need to have more of an emphasis on supervisors using the tools they have more promptly and putting in mitigants in place more promptly when they see problems at banks that they're supervising.
Yeah, in fact, they had a number of MRAs, MRIAs, I guess, and it didn't seem like you did anything other than write a letter. I mean, it didn't seem like there was any enforcement. I mean, where was the stick?
Yes, I think that's exactly the right question. Normally, in the supervisory process, when a supervisor issues an MRA or an MRIA, the bank promptly takes care of those matters. In this case, obviously, it didn't take care of them in such a way that it prevented its
It seems like they blew you off. I mean, it seems like they blew you guys off and you didn't do anything. I mean, that's what it seems like for reading all this information. I can tell you, maybe I'm wrong, but that's what it sounds like.
Yeah, I think that, again, we're looking at the whole supervisory record. I share your concern very much. I think it's something we're going to have to explore both in terms of the way the bank responded and the bank's responsibility for its failure, but also should regulators have used tools to escalate more promptly and quickly? I think that's a completely fair question.
Okay. Chairman Gruenberg, in your hearing before the Senate Banking Committee, you testified that the collapse of SVB and Signature Bank demonstrate the implications that banks with assets over $100 billion can have financial stability issues. I think that's what you were quoted. Additionally, you stated that the prudential regulation of these institutions merits serious attention, particularly for capital liquidity and interest rates hike. Can you please elaborate more about what prudential regulations need to be reviewed? What steps can we take to mitigate the potential for similar bank failures?
Thank you, Congressman. Look, I think we should start with supervision and how we supervise liquidity risk. And two big things in this episode was liquidity risk from concentration of uninsured deposits and the accumulation of unrealized losses on the balance sheets of our institutions, both of which go to fundamental management of interest rate risk, which is...
Right, but the size, I'm talking about the size of the bank. I think that's significant.
And I think it applies to all institutions. I think in the past, we've looked at these regional banks and smaller regional banks, and in terms of their prudential regulation, have treated them somewhat more lightly than the larger institutions.
My time is expired.
In light of this episode, we need to take a close look at that.
Thank you.
That was the point I was trying to make.
Well, with the wind-up that Mr. Vargas gave, I just want to give him like 10 more minutes, so thank you. With that, we'll now recognize Mr. Loudermilk of Georgia for 5 minutes.
Well, thank you, Mr. Chairman. Thank you all for being here. I know you've been spending a good bit of time on Capitol Hill, but we appreciate you being here. One of the concerns that I've received from a lot of my smaller institutions, smaller banks, is with the extension of insuring deposits across the board, they felt vulnerable in that larger institutions may decide to pull deposits that they have in the smaller institutions because then they would be covered. Under Secretary Liang, I wanted to get a little clarity on what seems like is conflicting accounts from Secretary Yellen regarding deposit insurance. Now, on Tuesday, March 21st, the Secretary suggested deposits would be insured. She said, quote, if smaller institutions suffer deposit runs that pose the risk of contagion, then during, that was the end quote, then during her testimony to the Senate Finance Committee the very next day, the Secretary said she was not considering, quote, blanket insurance or guarantees of deposits. But then a day later, she said that Treasury, quote, would be prepared to take additional actions to protect depositors if warranted. Could you clarify the Department of Treasury's position regarding deposit insurance?
Yes, thank you, Congressman. As Secretary Yellen has said, we have used tools to prevent contagion in the banking system and have reflected a commitment to ensure that all deposits are safe. And that means we would use the tools again, if needed, to ensure that Americans' deposits are safe.
So your answer is yes, you would include smaller institutions, smaller banks, community banks, or, I mean, I'm a little confused.
If conditions warranted, that would, deposits that smaller institutions could pose a risk of contagion to the broader system, we would absolutely use the tools.
So I guess the question would be then, what is that condition? If it starts with one community bank, then that would be a trigger, or do you have more definition of what would be the condition?
I think it's very difficult to just make decisions on the hypothetical, but in this environment that we made the systemic risk determinations based on unanimous approvals from the FDIC and the Fed, we determined that the risk of contagion in the banking system was very high.
So with that and the action of extending it to larger institutions, regional banks, and then smaller institutions, do you have concerns that regulators may be creating moral hazard across the entire banking system?
I think the We are concerned with addressing the current situation that we are facing. We think the system has stabilized. We have information and evidence that deposits have stabilized. We will need to address reforms going forward to address concerns about moral hazard.
Okay. And I agree with you. I think that we're stable at this point, but as we've seen already, things can turn around in a 24-hour period, right? And I am one of those that, you know, from raising 3 young children and now with 5 grandchildren, consequences matter in future behavior, and we can't ignore that going forward. Last question. Why did the Secretary's position appear to change regarding the extending insurance to various or to smaller institutions? Why did she change her position between the 21st and 23rd? Were there internal discussions going on between the Secretary and the President or other prudential regulators that caused the shift?
I am not aware of any conversations.
Okay. Well, I appreciate that, Mr. Chair. No further questions at this time, and I yield back.
Mr. Casten of Illinois is recognized for 5 minutes, and after this end of the series, sorry, let me restate this. After these 5 minutes, we'll give the panel a little 5-minute break, stretch your legs, then we'll come back in and we'll finish with questioning. My expectation is that then we'll be able to get through this final segment, but I do think it's humane to actually give a panel this bit of break, and frankly, I need one as well. So, Mr. Casten, 5 minutes.
I'd like to thank the chairman for putting me on the inhumane end of that transaction. Vice Chair Barr, I'm trying to understand the calendar, and I've got just 4 or 5 questions for you, and I want to walk through the calendar as I understand it. If you disagree with anything I've got in the calendar, let me know. But otherwise, I'll just try to run through quickly to get to the questions. January 2019, SVB is notified by the Fed of deficient risk management. A year later, they're notified that their risk management is not up to large bank standards. About 2 years after that, April 22 to 23, SVB no longer has a risk officer, but in their 2023 proxy statements, they say that they have doubled the number of risk meetings from 9 to 18. Given the prior concerns from the Fed, did the Fed participate in or otherwise have visibility into any of those risk meetings at SVB in that window?
The calendar you described, the dates didn't, they are some of them in the future. I think that we might need to look at the calendar reconciliation together, or maybe I misheard.
No, I'm just going up to January of this year was the last date. From April of 22 to January of 23, there was no risk officer, but a doubled frequency. Did the Fed participate in any of those risk meetings within SVB during that 9-month period?
I don't have yet the full supervisory record, so I'm not able to answer the question, but we will have that information in the May 1st.
Okay. Do you know if they were at any time cited for violating Section 165 of Dodd-Frank that requires banks over $50 billion to have a risk officer for the 9-month period when they did not?
The deficiency downgrade that occurred in the summer of 2022 focused on a wide range of risk management practices at the firm and found them to be deficient.
Okay. Moving back to the calendar, Q3 of 2022, their 10Q showed that their held-to-security bonds were $15.9 billion undervalued relative to mark-to-market, and they had $15.8 billion in equity at the time. 3 months later, their 10K for the year showed a slight improvement. They only had a $15.1 billion overvaluation of their bonds and $16.3 billion in equity. Was it perceived by the Fed or by management that they were in an improved risk situation at the end of 2023 than they were 3 months earlier?
I don't know the answer to the question with respect to how the management of the firm were viewing the situation. The supervisors were telling the firm at that time that basically their risk models were divorced from reality, that the models suggested they'd earn more money when they were losing more money.
Okay, I'm glad to hear that, because now I want to move to 2023 and sort of what happened up to March 8th. January 26, 2023, about 3 weeks after they finally got a risk officer back, CEO Becker announced that he was going to execute $3.6 million in stock sales. February 22nd, he executed those sales. March 8th of 2023, he announced a sale of all of their available to sell equity portfolio to Goldman. The same day was disclosed the $1.8 billion loss of a securities sale, apparently also to Goldman. Heads Goldman wins, tails Goldman wins. And of course, the next day, a $42 billion withdrawal. Do you have any visibility, when was the security sale and or the equity sale to Goldman process initiated? In other words, when was it announced? When internally was the company initiating the process to secure additional cash from those two Goldman processes?
I do not know the answer to that question.
I imagine you probably also don't know whether the January 26 sale was cleared with their risk officer, who had been on board for 3 weeks when the January 26th announcement was.
I don't yet have full visibility into that transaction. I hope that we'll be able to get as much detail as we can as part of our review.
Okay. Do you know, if I'm Becker, I'm obviously in a lot of trouble. You've got a deposit base that is extremely well-heeled and very sophisticated. Was there any outreach to the depositors during this period to ask them either to provide equity infusions to the bank or other forms of capital prior to the run of the bank?
I do not know.
Last question, in the exchange with Mr. Scott, you had indicated that and I think I got this right, that the Board of Governors' concerns about SVB were really heightened in mid-February?
What I said is that the staff presented to the Federal Reserve Board of Governors in mid-February on interest rate risk generally, and one of the firms they highlighted as having interest rate risk was Silicon Valley Bank. And the staff indicated that they were doing a further horizontal review and would come back with further results of that review.
Okay, so is it your position that the trigger for the heightened security was simply interest rate movement, or was it anything else about this calendar that triggered that heightened concern?
I didn't describe it as heightened concern. Basically, the staff were presenting on interest rate broadly, and the firm they singled out as having interest rate risk was Silicon Valley Bank, and they discussed the horizontal review they were doing and the fact they'd come back with further information after that horizontal review.
Okay, thank you. I yield back.
Is he supervision? Okay. We'll now stand in recess. Committee stands in recess for 5 minutes.
The committee will come to order. The chair now recognizes Mr. Rose for 5 minutes.
Thank you. Before I get into my questions, Chair Gruenberg, I'd like to say that as you consider any new special assessment on banks to replenish the deposit insurance fund, that you use your special exemptive authority in implementing that assessment to ensure that Tennessee bankers, and frankly bankers in a number of other states across the country, are not paying for the mistakes of Californian and New York bankers serving wealthy real estate moguls and tech-related venture capitalists. Tennessee bankers understand how to manage risks and should not be punished for the mistakes of those in our coastal banks. Now I'd like to jump right into my questions as time is limited. Chair Gruenberg, the value of First Citizens Bank is up over 50% over just the last 5 days and is still rising. Shareholders have benefited by $3 billion by last calculation. Chair Gruenberg, why did the FDIC cap its potential gain on First Citizens stock at $500 million?
I think it was a negotiation, Congressman, and that's what we were able to work out.
And so why not allow the federal government to recoup more of its losses? Why not and share in this outsized gain at First Citizens?
I wouldn't argue with that, but we had a negotiation with the acquiring institution, and that's what we came out with.
Okay. You think you had good negotiators at the table?
Maybe we could have been better. I don't know.
Okay. And Chair Gruenberg, Did you receive any pressure from the White House or other elected officials not to allow for consolidation of large or mid-sized banks with Silicon Valley Bank as part of the review process of potential bidders?
No, Congressman.
Okay. Vice Chair Barr, as you know, as committee members, we have been undergoing a series of briefings with regulators, both at the state and federal level, on these bank failures. Earlier this week, I learned that the California banking regulators were conducting their examinations of SVB remotely. Vice Chair Barr, can you tell us whether or not the Fed was also conducting its examinations remotely or on-site and in person?
My understanding is that there's a mix of activities. I don't know how much was on site. A lot of activity occurs remotely, doing analytical work and so on, but I don't have a precise answer to that question.
I hope you will provide that answer to us. As a former bank board member, I know there's nothing that strikes fear in the hearts of a banker more than an on-site review, and maybe for good reason and perhaps more effective. So we would like to know, I'd like to personally know the answer to that question as you conduct your review. You said earlier, and I think reaffirmed your quote, that this was a textbook case of mismanagement. I hope that you will conduct the thorough review to decide whether the oversight by the Fed examiners was being done in the way that it should, and that the escalation of that up to the through your process was appropriate, and that you will take appropriate actions. It seems to me, and I'll just say that, again, based on my personal firsthand experience, that you have the tools you need, and the question is, were they being used effectively? And I hope that in the days ahead, weeks ahead, we get to the answer for that question. Under Secretary Liang, earlier my colleague, Mr. Loudermilk, was questioning you about some of the comments of Secretary Yellen. And I guess I'm still a little bit confused, because I think what I'm hearing both from the Secretary and maybe from you is that if it's a systemically important bank that's failing, that there's going to be perhaps a more strident effort to make sure that no one loses. But if it's a less significant bank, like maybe the one that I was a director at, that perhaps the concern won't be as high. And can you clear that up for me, and am I mishearing what you and the Secretary are saying?
Yes, Congressman. The point that we've been making is that we would use the systemic risk exception or our end tools to prevent contagion in the broader system if a bank were to fail. And that could be a bank of different sizes, and it would be designed to keep all American depositors safe.
You understand, no doubt, the confusion that these statements leave some of us with. And so I just wonder, do you have confidence in Secretary Yellen at this stage?
Absolutely.
And so, as I think about what I've heard today, earlier Al Green, I know it's not a quote of my mother, but it's a quote I heard often, is that it doesn't just have to be right, it has to look right. And so as I leave you, gentlemen and ladies, this afternoon, I would just say the American people are watching, and I think right now we have grave concerns about whether the regulatory process looks right. And so I hope you take that to heart as you conduct the review of what you're doing. I don't think, my personal conviction is that you don't need new tools, that you need better craftsmen using those tools to accomplish the purposes that you have. And so I commend that to you. As a former bank board member, I feel like if Silicon Valley Bank had had the supervision that I feel like our bank got, that we wouldn't be here today talking about this. Thank you, and I yield back.
The gentleman yields. The gentleman from New Jersey, Mr. Gottheimer, is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member Waters. The conditions at Silicon Valley Bank in the months leading up to its failure set the stage for a classic run on the bank. What was not typical of the situation, though, was the speed and intensity of the run, as we've talked about. Depositors driven by panic on social media platforms and armed with online banking tools capable of rapidly moving large sums of money withdrew nearly $42 billion in deposits within 24 hours on the 9th of March. Under Secretary Liang, do you think social media and online banking tools have the potential to increase the intensity of future runs? And if so, what do you think the appropriate response from Treasury, Congress, and regulators should be?
Congressman, I do agree that the runs that occurred at Silicon Valley were unprecedented in speed and size, aided by social media technology. Those are new risks that challenge the banking system and the financial system, and are those that we'll definitely need to be considering and working with Congress on those issues.
So you're working on that?
Yes, we've been working on how to think about the payment system, how to think about fintech and digital assets, and this has now also become apparent.
Thanks. I'd like to work with you on that. If that's okay, I'll follow up. Thank you. Some members of Congress are using the failures of Silicon Valley's bank management and bank supervisors to criticize the bipartisan 2018 amendment to Dodd-Frank that ended the one-size-fits-all approach to bank regulation. Before Dodd-Frank, we had a system of too big to fail. We don't want a system, in my opinion, where banks are too small to succeed. Those that say Congress eliminated annual stress tests and other prudential safeguards need to read the bill again. The bill tasked the Federal Reserve with crafting rules for banks like SVB with more than $100 billion in assets. And Section 104 of the 2018 amendment to Dodd-Frank says clearly, quote, the Board of Governors may, by order or rule, apply any prudential standard established under this section to any bank holding company with assets equal to or greater than $100 billion if the Board of Governors determines the prudential standards is appropriate to mitigate risks in the banking system and promote safety and soundness. End quote. The Federal Reserve could and should have applied annual stress tests to banks like SVB, but it chose not to. While stress tests are an important component, it's clear that the existing Fed supervisory tools are equally, if not more important. During a Senate Finance Committee hearing earlier this month, Treasury Secretary Yellen was asked about supervisory stress tests, and her response was, quote, supervisory stress tests focus on capital and not on liquidity. In these bank failures, liquidity played an important role. When Secretary Yellen was asked whether stress tests would expose management failures at banks, she replied that, quote, that's the purpose of supervision, concluding that supervision is critical. Vice Chair Barr, do you agree with comments made by Secretary Yellen that supervision is critical to identifying the failures of bank management? And there was clearly there was a huge hole in Fed supervision of SVB. Can you talk about that a little bit, please?
I think supervision and regulation both play an important role in overseeing bank management. And obviously, in the first instance and in the last instance, it's bank management that's responsible for running the bank. And in this case, it did it in a way that caused its failure. We are taking a careful look at the role of supervision and regulation and not forcing managers to do a better job in running their own bank.
Just digging in a little that more, the Wall Street Journal reported that the Fed had concerns about the risk management practices at SVB as early as 2019. You admitted in your testimony that the Fed knew that there were issues at SVB for years and only started a more in-depth review in February 2023, which I worry was too little too late. When exactly does the Fed give these supervisory reviews some more muscle and step in to prevent disaster? And can you talk a little bit more about what happened here and what you're trying to learn? Thanks.
Thank you. A great series of questions. You know, the Federal Reserve's system of supervision and regulation is based on a tailored approach where firms between 50 and 100 billion are really part of the regional banking organization group. Firms 100 billion and above are in the large and foreign banking organization and group. And even within that, there are distinctions between firms at 100 to 250 and 250 and above. And I think part of the problem is that that framework, which really focuses on asset size, is not sensitive to the kinds of problems we saw here with respect to rapid growth and a concentrated business model. That's one of the reasons why, earlier this year I announced that we were going to have a novel supervision group that really focuses on these kinds of issues.
So to that point, do you think, you said yesterday before the Senate that the Federal Reserve has broad authority to apply additional prudential standards to banks with more than 100 billion in assets like Silicon Valley Bank. Is this a situation where the Fed needs different authorities, or has the Fed simply chosen not to use the authorities given by Congress? Like, where should you be jumping in?
We're going to look at our own framework, our own supervision, our own regulation. I think that self-assessment is really a critical part of risk management. As I mentioned earlier, we have a team of staff working on it who are not responsible for supervising SVB. We're going to look at our own structure and suggest reforms.
Thank you. I yield back.
Gentleman yields. The gentleman from South Carolina, Mr. Norman's recognized.
Well, thank each of you for testifying today. Let me ask a very simple question. You know, we had a $209 billion bank in assets, have a total meltdown from March 8th through March 26th. 18 days, you had a bank basically, from all outward appearances, was strong, to the taxpayer, to the investor. And over those 18 days, it was a meltdown. Now, the warning signs that have been mentioned at this hearing, like the 6 citations, like the absence of a chief risk officer for 8 months, like the deficient government and controls, the signals were there for a bank that was in trouble. When the chairman started it off, I didn't see a sense of urgency from any of y'all on things to do other than we contacted staff or we contacted the immediate supervisors. When I was a director on the bank, if one of these citations had been issued, somebody's head would roll. We'd be having a conference call. Give me some assurance that I'm wrong, or I guess give me some assurance what specific actions you would take if this is duplicated. Because you had $20 million lost in the insurance fund, which the calls I'm fielding in my office are from the smaller banks, and a lot of people denying the taxpayers are going to take the hit. The taxpayers are going to take the hit at the end of the day, because they're the ones that make the profit for the banks to pay the fees to the FDIC. Give me some, what does it take to get y'all's attention and to put a sense of urgency to situations like this?
I think it's an incredibly urgent situation. Obviously, when we learned of the immediate distress of the firm, we stepped in and took decisive action to make sure every American's deposits are safe, and we put in place a liquidity measure to make sure that banks all across the country would have the liquidity they need in case any institution were
You're talking about over the weekend, when you found out on a Thursday, you're talking about over the weekend you took these steps. I'm talking about, did you not get these warning signals ahead of time?
Sir, the bank supervisory staff certainly issued those warnings to the bank. The question we're looking at, the review, is why those were not escalated in a more rapid way. I agree with you. We want banks to be paying attention to supervisors, and almost every bank in the country, as you just described, if you get a letter like this, you get a series of problems like this, they had many, many problems. I'm focusing on liquidity and management and interest rate risk, but they had many other problems too. You have a bank like that not responding, that's a real problem.
In your role as regulators, what would you do differently for each of you?
I think I'd start with making sure that we escalate things faster and intervene more promptly with respect to mitigation. But as I said, we've just started this review. I'm going to get a staff review back, and I want to really hear their expert judgment without any preconception about what they're going to come up with.
Did they jump to conclusions on having this as a systemic risk?
Pardon me?
Was it the right decision for the president to issue this, or I guess the board that voted on it, to issue this as or to deem this a systemic risk?
I think it was the correct judgment, sir. It was a very difficult judgment, I know, for everyone, but a unanimous Federal Reserve Board, unanimous board of the FDIC, and the Treasury Secretary agreed after consulting with the president. I think it was the right thing to do for the country. I think it saved a lot of small businesses and households, community banks, regional banks, from a kind of contagion that really could have been quite destabilizing. And we're now in a situation where I can say the banking system is sound and resilient. I think that was really the right thing to do.
Well, I sure hope so. What this has done is rattle the markets. was in the commercial real estate business. And banks that are loaned into commercial ventures are shook right now, particularly on the concentrations of credit on where they put their money. And particularly for that family that's put their life savings in an account that they thought was insured. What about what's your opinion on raising I get asked questions, the $250,000 insured limit?
Yeah, let me respond, if I may, Congressman. Seems to me that the decision to guarantee the deposits of these two institutions really raises that question up. As I indicated in my testimony, the FDIC is going to undertake a comprehensive review of our deposit insurance system. Certainly one of the things we'll look at and identify different options for consideration is the scope of coverage and whether we should increase coverage overall or for particular
Well, I would like to
types of
see, I'm
accounts.
running out of time, I'd like to see those reports, if you could furnish that, as well as if a rerun of what happened to these two banks happens again, what decisive role y'all would take that you may have not taken earlier. I yield back.
And the report will be out by Congressman, the report will be out by May 1.
The gentleman yields. The gentlewoman from Massachusetts, Ms. Pressley, is recognized.
Thank you, Chair McHenry, Ranking Member Waters, and all of our witnesses for joining us for this critical hearing. I know it's been a long morning, but that being said, I truly hope that this is the first and not the last hearing that we're going to have on these recent bank failures. Now, when SVB collapsed, in my office received urgent phone calls, texts, and letters from throughout our district from our constituents who were genuinely shocked and afraid for their future. Affordable housing residents unsure about the status of mortgages, tech companies not able to pay their employees, small businesses worried that they had lost most of their money. Now, while I'm glad we did avoid the worst possible scenario, Congress should consider SVB collapse a wake-up call and take action. After the 2008 financial crisis, Congress stepped up to enact Dodd-Frank, a comprehensive package of regulations in order to prevent bank failures and systemic risks that hurt the economy. However, in 2018, the Republican majority in Congress passed a deregulation bill that stripped away crucial requirements and got rid of enhanced prudential standards. Donald Trump and Republicans, including some of my colleagues sitting in this very room, celebrated signing this dangerous piece of legislation. The 2018 deregulation law specifically made it easy for SVB and Signature Bank to engage in risky management practices with little to no oversight, and we must rightfully assign some of the responsibility for this bank turmoil to deregulation efforts. Vice Chair Barr, when Congress passed the deregulation bill in 2018, which was lobbied for by banks like SVB, is it fair to say that it reduced supervision requirements by the Fed for small and medium-sized banks?
The overall effect of the law was for the smallest banks to reduce regulatory burden for banks within 50 to 100 billion in range to limit the Federal Reserve's discretion with respect to those institutions. But for institutions over 100 billion, the Federal Reserve retained discretion to do something different. It chose in 2019 to put in place a set of rules that I think had the effect overall of reducing supervision and regulation of such firms.
Right, so it definitely did. The deregulation bill relaxed requirements for stress tests and resolution plans. The dangerous and irresponsible nature of this deregulation bill was completely predictable. In no way was this turmoil inevitable. The then Federal Reserve Governor Brainard opposed it, as well as both of you, Vice Chair Barr and Chair Gruenberg. And yet here we are. In the aftermath of the collapse of SVB and Signature Bank, it's clear that the Republican deregulation bill shares the blame alongside Treasury, the Federal Reserve, and the FDIC due to the lapses in supervision and oversight. Chairman Gruenberg, for folks who are concerned about the future of small and medium-sized banks in this country, what assurances can you give them?
Well, Congresswoman, as a general matter, our small and medium-sized banks remain in good condition, including their liquidity. And I think the actions we took did help to stabilize the system. And I think, as I indicated, any expense by the Deposit Insurance Fund to cover uninsured depositors will be imposed through a special assessment on the industry, and we have discretion to tailor that assessment to the institutions that most directly benefited. So we're going to try to be thoughtful in this process.
Thank you, and I'm requesting that each of your agencies provide my office and this committee by May 1st a list of recommended regulations that need to be enacted to strengthen the banking industry and to prevent future failures. The story of SVB's collapse is the story of a Republican administration in cahoots with the banking industry to weaken our financial regulations, but it is also a story of regulators' failure to do their number one job, regulate banks. And since I'm accused of this often, I think I will close with a wokeism. The American public are tired of the super wealthy pocketing bonuses and leaving working class folks hiding the bag for their fiscal mismanagement. They're even more tired of Congress allowing them to do it. It is time to regulate. Thank you, and I yield.
The gentlewoman yields back. The gentleman from Ohio, Mr. Davidson, is recognized.
Thank the chairman, thank our witnesses, appreciate your endurance here today and yesterday. And as I listened to my colleague ask questions, I know my constituents are tired of seeing Washington, D.C., Congress in particular, socialize risk and watch profits be privatized. But they're also tired of people that don't listen. So I think one of the things that, Mr. Barr, when I was listening to what you said yesterday and today, S2155 isn't the reason that these banks failed. These banks were over $100 billion in assets, and therefore it's just a red herring. Isn't that accurate?
What I would say is that the Federal Reserve's rules issued in the wake of 2019, in the wake of the legislation that were issued in 2019, they did have the effect of lowering supervisory and regulatory standards for firms, but the Federal Reserve retains the discretion to have different rules. And one of the things that I think would be my job going forward is to put in place rules that are appropriate for that size institution. We have the discretion to do that.
Yeah, thank you. And so obviously it wasn't the regulation per se that failed, it was the regulator that failed. And I want to understand the context in which that occurred. So over the past year and a half, we've seen a substantial increase in the federal funds rate. And during that span, are you aware if the Fed or other prudential regulators had conversations, not specific to Silicon Valley Bank, about the inevitable interest rate risk that presents?
Yes, that is a core topic in supervision. Supervisors were very focused on interest rate risk. It was an important part of what we highlighted in our fall supervision report. Examiners were given beginning this year extra training, beginning last year, extra training on interest rate risk. So it is just a bread and butter supervisory issue. It's not some esoteric problem.
So in that sense, did Silicon Valley Bank's failure surprise you?
Its failure did surprise me. Its risk-taking was excessive, but even then, I did not anticipate, I don't think anybody anticipated, that they'd have a devastating bank run that basically wiped out, $42 billion on Thursday afternoon, another $100 billion expected the next day. That would be 85% of its deposit base in a 24-hour period. That was shocking.
Yeah, so we're anxious to understand all the factors that drove that run on that particular bank. But we're also curious when you stated yesterday to Senator Kennedy that stress testing does not examine institutional risks precipitating from interest rate risk. And when we were on the conference call with Treasury, with Fed, with FDIC, with House and Senate Republicans and Democrats, I asked the question, and there's some complex model that the stress test involves, and said, well, if macroeconomic conditions and whatever kick in, well, I submit that the hold to maturity spread has to be considered, not just the available for sale risk because of the need for liquidity. Is that something that you're focused on as you conduct your review?
Yes, I think you're absolutely right that we need to look at both sides of the balance sheet. We need to look at the liability structure and the asset structure, and the whole point is to assess whether under certain conditions you can have more stress on the liability side that forces you to sell on the asset side. Those are interrelated.
Mr. Gruenberg, do you share that concern about how we're looking at systemic risk?
Yes, I do, Congressman.
I would love to go into everything that I could on this, but Mr. Barr, on March 9th, you gave a speech that touched on stablecoins and brought up specific risks associated with stablecoins. In that speech, you stated, quote, this mismatch in value and liquidity is the recipe for a classic bank run. Stablecoin issuers are not supervised by the Fed and lack capital and liquidity as a backstop. The banks we regulate, in contrast, are well protected from bank runs through a robust array of supervisory requirements. Would you revise those comments if you could?
Yes, I think that, it demonstrates the need for humility in thinking about how financial risk happens in the system. That's been a theme of basically all of my academic work on systemic risk is we need humility, and that's why you need really strict capital and liquidity rules because of exactly the kind of circumstance we just saw.
Yeah, thank you for that. And note, obviously, stablecoins are backed by assets and are properly regulated in many states, including the state of New York. Last thing I'd say is we have this pressure to socialize more of the market. There are credit unions that are completely privately insured, many in my district and in others, and I think we should look to that market for private credit risk insurance. I yield.
The gentleman yields. The gentlewoman from Michigan, Ms. Tlaib, is now recognized.
Thank you so much, and thank you all for being here. Vice Chair Barr, Silicon Valley Bank, which I feel like no one's focusing more on them as the bad actor here, in the mismanagement and the inappropriate actions. You know, you kept saying over and over again that they weren't responding. If you had, you know, we should have done something when we knew they weren't responding. I mean, what could have been done?
It's an excellent point. I mean, I agree with you. You start with the basic problem that the bank managers mismanaged the bank.
Did they hide something from us? What did they hid all this from us? Do you believe they hid this intentionally from the feds?
I don't have access yet to the full supervisory record.
Will
to
you
be able
let
to
us know?
answer
Because
your
I really
question.
do think they misled and probably lied and made some inappropriate and fraudulent probably actions that I hope that we'll hold them accountable to.
We will definitely be looking into that, and we retain enforcement authority to go after people who, at the bank, who violated the law or who breached their fiduciary duty or who engaged in unsafe and unsound practices, and we will hold them accountable
Yeah, and
to
Chairman
the full
Gruenberg, let's
extent.
not negotiate with bad actors like that. We think this is the time to really hold them accountable, honestly. This is how we set a precedent. But going back to you, Vice Chair Barr, bonuses were paid out when? When was the last bonus paid out before they
As I said, I'm still getting access to the supervisory
We know it was a
record.
couple hours before, correct?
I've heard news reports about that, but I want to make
So
sure
you don't
that
even
I
know
get
when the
full-
bonuses were paid out? You don't have that information for this committee right now?
I do not have that information
Was
right
it the
now.
day of?
I would like to respond to you fully and accurately, and I want to be careful to do that properly. I've heard news reports about the timing, but I don't
How
have
come
the
the
full...
news knows, but we don't?
Pardon me?
How come the media and the news know, but we don't? How do you not know this before our financial service? Because this is important.
I agree with... I share your outrage about it. I just want to make sure we get to the facts.
Do you even know how much the bonuses were?
As I said, I think you're hitting at exactly the right issues. We're going to use our enforcement authority to the fullest extent possible.
Well, now, you know, everyone's saying, oh, we're going to go ahead and introduce some clawback legislation to see. But, you know, Chairman Gruenberg, I asked the Fed Chair Powell about this. You know Section 956. It's been, what, 12, 13 years? When are we going to have a rulemaking on that? This is about excessive pay. This is about, I mean, this is something that Congress already considered. So how come it's over a decade that we don't have anything rulemaking? In 2016, there was a proposal. It wasn't great, but it was a really great start. It would have been instrumental here.
Yeah, no, I'm familiar with the rulemaking, Congresswoman. I was strongly supportive of it. We didn't complete it in time.
Why?
Well, I think there was a change of administrations, and that may have had something to do with it. Every reason to come back to it now and complete that rulemaking, and I
If
think
you had it today, what could you have done with,
Well,
in this instance?
it would have
Because
given us-
I'm tired of us being asked to pass things when I
would
feel
have-
like we already did, but
it would
it's
have
over
given,
12 years that we don't actually have something again that we could have used as a tool.
it just answered, it would have given us explicit clawback authority on compensation. As I pointed out earlier, we do have, in fact, a legal obligation, the FDIC, to investigate the board and management of failed institutions and hold them accountable for any misconduct that might have occurred.
Yeah, public advocates really believe this could have maybe prevented this.
And so we'll...
Primarily because, as you guys know, that there's some inappropriate decisions made up so they can do the bonuses
And that's...
and the payouts.
And that's what we're
It
going
is
to...
clear as day, and I don't know why my colleagues are not even talking about that.
as
They're
I've-
talking about you all not getting things that, well, they didn't respond. How come nobody's mad at the bank for not responding?
All I can tell you, we've initiated the investigations to get the facts, to take action in regard,
Chairman-
assuming the facts support
Chairman
the
Gruenberg,
allegation.
please, for the American people, we need a rulemaking decision on Section 956. You know how critically important this is.
Understood.
This is what, I think it was, I read somewhere, this is the 563rd bank to fail since 2001. There are going to be more. And I know you guys don't want to talk about it, but there will be, because they'll mislead us, they'll lie, they'll do anything for the buyouts. I mean, even the risk, what's that risk manager person? What did she give herself? What was it? I mean, this is a crazy amount of money she walked out with. I mean, it's crazy. And then Gary Becker, the CEO, sold February 27th, $3 million worth of stock, netting $2.2 million. And he knew this was going to be where we land. And we're not angry about that. We're angry because you guys didn't notice. Well, what about the fact they don't respond? They don't respond to inquiries and things. I mean,
The
that
gentleman's
to me
time has expired. The gentleman from Pennsylvania, Mr. Meuser, is now recognized.
Thank you, Mr. Chairman. We know that the receivership for SVB occurred on Friday, March 9th. Sunday morning, Secretary Yellen stated that the American banking system on national television was really safe and well capitalized. On Sunday night, Secretary Yellen approved the FDIC to protect all depositors at SVB, and certainly implied all bank deposits beyond the $250K would also be secured. So my first question to Vice Chair Barr, what data over that time period drove you to go beyond the SVB and Signature, which was made aware, I guess, on Sunday? And did you think that if you were to protect an idiosyncratic bank such as SVB, you would need to protect all? What data drove you to imply that all bank deposits would be secured?
The decisions that we made that weekend were obviously in a very compressed period of time. They involved not only gathering information about what's going on in the economy, but also the exercise of judgment. It was our judgment collectively on the Federal Reserve Board, unanimous decision of the FDIC and the Treasury Secretary, that we needed to do that to protect contagion from infecting healthy banks in the system, community banks, regional banks around the country. It is a judgment call. It was based on the information we had at the time. I think it was the correct decision.
I don't want to prolong it, but so there was actual data from other banks that they could be in jeopardy from a systematic problem.
I'm sorry, I didn't mean to
It being a
cut you off.
systematic problem as opposed to a unique problem?
As I said, it's a human judgment, but the information we were getting from other regional banks suggested pressure that was building.
It may have been the right call. I'm just wondering what data drove Secretary Yellen to go from, hey, everything's okay, to 8 hours later, no, we're going to protect all deposits. I'm going to move on. Chair Gruenberg, it was stated that as well as all bank deposits being secured, no cost to taxpayers. I understand the FDIC fund is understood to pay for it, as you stated, per law. But will FDIC rates go up on community and regional banks? And aren't banks taxpayers too?
Oh, they certainly are, Congressman. As I've explained previously, just to be clear, the action covered uninsured depositors at those two institutions. And the FDIC is required by law that any loss to the deposit insurance fund as a result of those uninsured deposits has to be paid for by a special assessment on the banking industry. And we have authority under the law to consider the types of entities that benefit from any action taken or assistance. So we have discretion in designing the implementation of the assessment. Okay. And as I indicated previously, we're keenly sensitive to the potential impact on community banks.
Well, good, because they are very concerned, as you know, community and regional banks, that they will pay for the bad actions of a few. And I'm glad you're very much aware of that. So, Vice Chair Barr, excessive spending by Congress, QE, the Fed doubling its balance sheet from $4 trillion to $9 trillion, no surprise to you, followed by the quantitative tightening, many banks holding excessive treasuries were highly devalued and devastated in the case of SVB. So the November 21st, there are reports that the Fed, on November 21st of 2022, there's a report that the Fed was aware of the balance sheet issues of SVB. Were you, I mean, this is the 16th largest bank in the country, 57% of its portfolio was in treasuries being devalued. Why wasn't there more enforcement taking place?
I think it's an excellent question. We were aware and focused at the supervisory level of interest rate risk in the firm and liquidity risk of the firm. I don't think the supervisors expected, I don't think anybody expected a devastating bank run of the kind I described before, with 85% of deposits fleeing or expected to flee in a 24-hour period.
16th largest bank. You can see why people find that unacceptable from an enforcement standpoint. Lastly, I only have 10 seconds. There's a high concentration of commercial real estate loans out there owned by small banks, potentially as loans will be. I'll follow up with you on that one in writing. I yield back, Mr. Chair.
The gentleman yields. The gentleman from New York, Mr. Torres, is recognized.
Thank you. When interest rates rise, long-term securities become less valuable, but deposits become more valuable. If you have a stable deposit base, the gains from the deposits can offset the losses from long-term securities. But if you have an unstable deposit base, like Silicon Valley Bank, there's no built-in offset. Silicon Valley Bank had a uniquely uninsured, unstable deposit base that made it singularly susceptible to a bank run in the age of social media. So, Vice Chair Barr, should a bank with an unstable, uninsured deposit base like SVB be subject to a higher standard of regulation than a bank with a stable, insured deposit base?
Representative Torres, I couldn't have said it better myself. I think you described the situation exactly correctly. And the unique...
Flattery will win you no points, but sure.
It's just the truth. I wish I had said it that way. But no, I think there are unique risks to this kind of heavy uninsured deposit base. And for most banks in the country, as you described, they handle their interest rate risk properly. They have stable deposits. I know all of you, and when you talk to your banks and you go back home across the country, they're doing okay.
But you agree that the rigor of regulation should depend not only on size, but on deposit stability, yes?
I do.
Regarding commercial real estate, the rapid rise of work from home during COVID has driven down office property values, and the rapid rise of interest rates have driven up financing costs, creating a perfect storm. Office buildings with declining property values are set to be refinanced at far higher interest rates. There's reportedly $2.5 trillion in commercial real estate debt coming due over the next 5 years, a substantial share of which is office debt. Chair Gruenberg, to what extent do you worry about the office loan portfolio representing a ticking time bomb in the banking system?
It presents a risk. It's one the FDIC has talked about and identified publicly.
And Signature was the largest commercial real estate lender in New York City. How much of Signature's commercial real estate portfolio consists of office real estate?
That's a good question. Let me get you the exact note. It's a substantial portion of.
Can you get me back an answer in writing?
I can get that for you.
More important to me locally, residential real estate. Signature Bridge Bank has a housing portfolio of 3,000 properties consisting of 80,000 units in New York City. The portfolio includes 479 properties consisting of 19,000 units in the Bronx, where I serve as a congressman. I have two questions for the FDIC. As you go through the process of seeking a buyer for Signature's residential real estate debt, to what extent will you seek the input of New York State and New York City housing officials who have an obvious stake in preserving the affordability of these properties and units? And to what extent will you prioritize affordable housing preservation in your selection of a purchaser?
Thank you, Congressman. Just to be clear, we have sold Signature to New York Community Bank.
You sold everything but the real estate portfolio, as I understand. That's been publicly reported.
I take your point. No, we'll be glad to work with you and other local officials in New York in regard to the disposition.
I appreciate that commitment.
Sure.
I'm not advocating the following course of action, but I want to provide you with a hypothetical. The banking system is reportedly sitting on more than $600 billion in unrealized losses from securities, and those losses will only rise with rising interest rates. Since the problem with these assets is one of asset duration rather than asset quality, should the Federal Reserve consider purchasing these securities? Unlike a bank, which needs liquidity to honor obligations to depositors, the Federal Reserve has the ability to hold these assets to a maturity without realizing those unrealized losses. Wouldn't that solve the problem?
You raise an excellent point. Under existing law, we cannot do asset purchases, but what we do is provide ample liquidity to the financial system on the basis of those
But the
assets.
losses remain, even with the emergency liquidity, the losses remain on the balance sheet. Those losses are arguably undercutting public confidence in the banking system, and as you know, banking is as much about psychology as it is about finance. Why not just remove the losses?
I'd go back to the first point you made in your earlier question, which is that for most banks, they're managing this well. They're doing fine. They have stable deposits, and they don't need to sell the assets they have on their balance sheet. Those assets can stay there and be held to maturity. If institutions need liquidity, they can get access to that from the discount window. And from the program we established, the Bank Term Funding Program gives longer-term stability at par for those very assets.
I want to squeeze in one more question. Did the bank supervisor at the San Francisco Fed have the supervisory authority to prevent Silicon Valley Bank from investing in unhedged long-term securities? Did you have that authority? Like, is the problem a lack of authority or a failure to exercise the authority you had?
The bank examiners cited them for not behaving properly with respect.
But did they have the authority to prevent it?
The gentleman's time has expired. The gentleman can answer on the record. The gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman. It seems that Washington continues to create crisis after crisis and then come in to bail out the crisis. You go back to 2008, it was the policies coming out of Washington that everyone was entitled to own a home. And it didn't matter what their credit score was, whether they were able to pay it back. It was a human right. And fast forward a few years, the compounding impact of that resulted in the 2008 financial crisis. So what did we learn from that? I would argue nothing. The government came in, bailed everybody out, bailed out the big banks, caused chaos in the smaller banks, and picked winners and losers. And that's a theme I'm going to be hitting on, picking winners and losers, because the free market capitalism is supposed to have consequences. And when the government continues to bail out bad decisions and pick winners and losers, it severely impacts the free market, and it undermines our ability to compete in the global economy. So 2008, we understand the policies coming out of Washington caused a crisis. We had 2 votes. First vote failed on TARP, second vote passed. It was very painful. I was not here. But at the end of the day, it solved the short-term problem. But we didn't learn anything. We did learn one thing, actually. It was that the TARP vote wasn't fun. So in 2008, we gave extraordinary power to the executive branch to avoid a future TARP vote. And this is the first time that you all used that authority. So let's fast forward to 2023. A number of policies coming out of Washington, particularly the emphasis on ESG and on DEI, and that compounded with the spending of trillions and trillions of dollars that caused inflation, which resulted in higher interest rates, destabilized SVB and Signature. So we didn't really learn anything in 2008 because we used the 2010 authorities, the executive branch used the 2010 authorities to, again, pick winners and losers. So there's no consequences for risk-taking. There's no consequences for poor decisions. And we keep talking about what caused this. Really, it's 3 things. The San Francisco Fed's misplaced priorities. Last fall, when every other Fed was sending out notifications regarding interest rates and inflation and the impact on future stressors of the banking system, they were still sending out DEI and ESG updates. So that, combined with the SVB and Signature mismanagement and the inflation we created, caused this problem, and we have, again, not learned anything, bailed out, poor decision-making. I guess I want to start with Undersecretary Liang. Is this a problem? I mean, we invoke the systemic risk exception and cover both insured and uninsured depositors. Is it not creating more systemic risk in the overall system because capitalism is no longer a thing? The government's backstopping everything? Is that a concern?
Congressman, I understand your question and your concern. In this case, the systemic risk exception was taken. Depositors, all depositors were covered. Shareholders and debt holders were not. They lost their investment. Those who took the risk lost their investments in this case. I do think this situation, the actions were taken to prevent contagion to spreading to other banks. It was to help safe banks, small and other regionals, who were losing their deposits to either the largest banks or to outside the banking system. I do think this requires that we will need to be assessing and looking for
But the lack of consequences, the government continuing to pick winners and losers, and I mean, my biggest thing is the justification. Treasury and the White House both said that there's no taxpayer dollars, and that what about the people that are going to miss payroll? Neither one of those were necessarily true, because it is taxpayer dollars, because the increased premiums from FDIC is going to be passed down to Americans all over the country. And so they are taxpayers, so that is their dollars. It's not coming out of the general fund, but it's semantics. And as it relates to payroll, I mean, only $22+ billion is going to be at issue, so there were opportunities to make them whole. I just really think that, one, delegating the ability to bail out banks to the executive branch is dangerous, and two, bailing out these banks in this manner has caused more problems than was possibly worth it. And with that, Mr. Chairman, I yield back.
The gentleman yields. The gentlewoman from Texas, Ms. Garcia, is recognized.
Thank you, Mr. Chairman, and thank you and to the ranking member for bringing us together for this really important hearing. And I just first wanted to start with just a quick question to the three of you, because I've been troubled by the word of the use crisis. I know I shared that with the ranking member the other day, that, you know, I never saw this as a crisis. Perhaps it was a boo-boo, maybe a major boo-boo, but not a crisis. I don't think that, personally, that two bank failures equals a crisis. So I just want to quickly ask each one of you just a yes or no. Do you think this is a crisis, Mr. Barr?
As I said at the outset, I think our system is sound and resilient.
Is it a crisis or a yes or no?
I think that it was appropriate use of the systemic risk exception to prevent a crisis.
Is it a crisis, yes or no?
As I said, I think that where we are now, the banking system is sound and resilient. There was risk that if we did not invoke the systemic risk exception,
But you have used the word
it could have
crisis, is the question.
I have not used that word.
Okay. Chairman Gruenberg?
I think we were at risk of crisis, and I think the actions that we took have stabilized the system.
Ms. Yang?
I agree with that. The actions we took stabilized the system.
Well, I think you're right, and I think that's what we should focus on the swift action over a weekend, no less, and how we were able to avert a crisis, and how we were able to prevent contagion, and how we were able to frankly just save those banks, but potentially other banks. And I know that recently, as a ranking member mentioned, there's been some notion that it's the woke policies that have done this. And I know that some extreme MAGA Republicans, like Florida Governor Ron DeSantis, have even suggested that it was the ESG policies, and frankly, with zero evidence. But yet they continue with some of this rhetoric. Vice Chair Barr, yes or no again, do you believe that ESG investing played any role in the failure of Silicon Valley Bank?
No.
Mr. Gruenberg?
No.
Ms. Liang?
I do not have the information that the supervisors have, but I would, my strong preference would be no.
Right. Well, you know, as I said, there's been no evidence, and thank you for reaffirming that, because you will recall that the claim that ESG invested was caused by the failure of Silicon Valley Bank is really strongly reminiscent of the claim back in 2008 that the financial crisis then was because of the Community Reinvestment Act obligations. So very similar. The Financial Crisis Inquiry Commission examined this claim and rejected it, as did researchers within the Federal Reserve. Vice Chair Barr, will you remind us what researchers at the Fed have concluded about attempts to blame the housing and foreclosure crisis on historically disadvantaged communities of color?
The research showed that there is no basis for the conclusion that low-income, moderate-income consumers, households, were responsible for causing the financial crisis.
Okay. Do you think that the communities of color, the disadvantaged communities, and particularly people in my district that is 77% Latino, should be concerned that this bank failures and some of the remedies that are being put in place may cause a lack of capital, the lack of opportunities to be able to buy homes? Will it impact mortgage rates?
I think the steps that we took together to stabilize the economy and provide public confidence in the banking system are of assistance to low and moderate income households and to all Americans around the country.
But do you think there will be some negative impact on interest rates and the ability to borrow, to buy and purchase homes?
My estimate is that the bank's reaction to the current economic circumstances are likely to lead to a reduction in credit availability overall. That's something that we're watching very carefully at the Federal Reserve.
Right. And Ms. Liang, I had a question for you about crypto, and I know that there's an additional bank that is going through some process of voluntary liquidation. What role did crypto play in all this?
I don't believe crypto played a direct role in either of the failures. So that, yeah.
Was there an indirect role?
I know that Signature had activities involved in digital assets, but I don't believe that is the main.
The gentlewoman's time has expired. The
Mr.
witness.
Chairman, I will follow up with the three panel members on this issue. Thank you. I yield back.
The gentleman from New York, Mr. Garbarino, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman Gruenberg, I want to talk a little bit about Signature Bank. Can you describe the condition of Signature Bank at the time of its receivership and what evidence you had that showed Signature was also facing a liquidity crunch on March 10th? And what was Signature's available funding at the time New York State DFS closed the bank and placed it at FDIC receivership?
Congressman, we can get you the specific data, but the fact is that on Friday night, that bank had real difficulty meeting its obligations at the end of the day and barely met them by the 5:30 closing time. And I think both New York State and the FDIC, who jointly had responsibility, did not think that the bank could open and make it through the day on Monday. I think that was the determination. And that's why the New York State on Sunday decided to close the institution.
All right, and you can get me the specific numbers?
Yes, we can.
Thank you very much. And now I want to focus, I want to follow up on something that my colleague Tom Emmer asked before. When New York Community Bank Corp. assumed its Signature's deposits in some of its loans, it refrained from including roughly $4 billion of deposits related to Signature's digital assets banking business. As a result, Signature's real-time payments network remained under FDIC Commission's receivership. It was reported early yesterday evening that the FDIC sent a notice to depositors whose deposits were not included in NYCB's bid, informing them that any accounts not closed by April 5th will be automatically shut and depositors will receive a check in the mail. Can you walk me through FDIC's reasoning for this decision?
Yes, Congressman. So the winning bid for Signature by New York Community Bank's subsidiary, Flagstar, was for all the deposits except the winning bid chose not to bid on the digital assets. And there were about $4 billion of those, and we provided those depositors a couple of weeks to determine what they might want to do, and we sent them a notice that we'll return their deposits to them by early next week, I believe.
So in your response to Tom Emmer, you mentioned that Signet was included in the sale of Signature Bank, while the deposits were not. It is my understanding that you still currently are looking for, so you're still currently looking for a buyer.
So just so I'm clear, the digital deposits are being returned to their deposit holders. It's my understanding that Signet was not acquired and remained in the receivership and is in the process now of being marketed.
So Signet is still under FDIC
yes,
receivership?
It's in the process.
Thank you very much. Chairman Gruenberg, I also want to bring this up. In the Senate banking hearing yesterday, there was an exchange between Senator Van Hollen and Vice Chair Barr on the guidance on guidance issued in 2018 and codified in 2021 when Randy Quarles was Vice Chair of the Supervision of the Federal Reserve Board of Governors. This has become a target of some, even though
this initiative doesn't limit any action an agency can take. It simply clarifies which actions will be accomplished through regulatory measures and which through supervisory measures. You stayed silent during the entire exchange, but I recently read an op-ed in the Wall Street Journal written by Randy Quarles, which has said that both you and Lael Brainerd voted for this guidance. Is that true? Did you vote for this guidance?
Yes, we did, Congressman.
Okay. Thank you very much. And one more question. Sorry. Vice Chairman Barr, as we look back at the events over the past couple of weeks, there have been a number of similarities identified between Silicon Valley Bank and Signature Bank. The first of which is being the high concentration of deposits well above the FDIC insurance limit, with reports showing that 90% for Signature Bank and 87% for SVB. And the second being the lack of diversity in both banks' deposits. The news has discussed the potential impacts of these similarities ad nauseum. However, I would like to explore how the Federal Reserve and the FDIC view deposit diversification as it pertains to determining the soundness of financial institutions.
Sorry, I couldn't hear the last 4 words of your sentence.
I would like to, and I'm out of time, so I'll submit this question for you to respond on the record. Thank you so much.
The gentleman yields. The gentlewoman from Georgia, Ms. Williams, is recognized.
Thank you, Mr. Chairman. I want to start by making it clear that the failures of the Silicon Valley Bank and Signature Bank were not just about wealthy people, as some of the narrative that we've heard in conversation. There is a significant chance of a disastrous impact on hardworking people who are trying to make payroll, and it's important that this detail doesn't get lost in the shuffle. The weekend that SVB failed, I woke up to text messages from constituents asking what the government was going to do, what kind of intervention there would be, because they had money in this bank. Atlanta is this booming area for tech startups, and so the impact was felt very real by my constituents. They wanted to know if they would be able to access their funds on Monday morning. Black-owned businesses were worried about paying their employees. Entrepreneurs who are creating wealth in marginalized communities were concerned about covering basic business expenses. These businesses are closing the racial wealth gap, which unfortunately my home district of Atlanta leads the nation, and the banking system has to work for them. Chair Gruenberg, in the aftermath of SVB's failure, there has been substantial debate about raising the $250,000 deposit insurance cap to minimize any potential payroll disruptions and economic pain that may follow when the next bank fails, which my constituents were so concerned about. There is reportedly bipartisan legislation in the works to temporarily raise the cap. If the cap is raised or eliminated to help protect depositors, we'll need to take measures to reduce the risk of moral hazard. One proposed measure is the continuance of risk-priced deposit insurance premiums. Chair Gruenberg, as we consider different deposit insurance reforms, should we seek to maintain risk-priced deposit insurance?
Well, I think we do want to maintain risk-priced deposit insurance, but I do think, you change one part of the system, it impacts another part of the system. So, as I indicated earlier, the FDIC is undertaking a comprehensive review of the deposit insurance system in light of this episode, and will release a report by May 1, also laying out policy considerations for changes to the system that we hope will inform the discussion around this.
So beyond the report, moving forward, what steps can the FDIC take when making decisions about deposit insurance assessments to make banks think twice about various financial stability threats that disproportionately impact marginalized communities?
Well, we have authority now to do risk-based pricing, and I think it's fair to say that in light of this experience, we need to think hard about liquidity risk and concentrations of uninsured deposits and how that's evaluated in terms of deposit insurance assessments. But I also think it's an appropriate moment to take a look at how our system works in light of of this episode, and consider what other changes might be prudent.
Thank you. And we all know that part of maintaining a healthy banking system is confidence, specifically consumer confidence, that their money is safe in the banks that they've chosen. People of color have a harder time getting affordable loans from the largest banks and thus turn to the community banks, minority depository institutions, and the like. And when there is fear in the financial sector or an economic downturn, minority-owned banks and community financial institutions are hit hard as customers transfer their funds to what they think are safer and larger banks. Vice Chair Barr, what can Congress do to strengthen and support community and minority-owned banks in situations like we just experienced?
Thank you very much, Representative Williams. I agree with you that having a wide diversity of kinds of institutions in our country is really critical, including community banks and regional banks, minority depository institutions, and community development banks. All of these institutions, I think, are really important for economic vibrancy and inclusion in our society. We'd be happy to work with you on ways that we can continue to support those institutions going forward.
Happy to work with you, and we will definitely follow up. And Chair Gruenberg, I would love to hear from you what kind of deposit insurance reforms would help support minority depository institutions and other community banks.
It's an interesting question. You know, we're in the process of finalizing a major revision of the Community Reinvestment Act, and in the proposed rulemaking, there were specific provisions to encourage banks to work with and support minority depository institutions and community development financial institutions. So I think that's actually an important vehicle and opportunity to strengthen our MDIs and CDFIs, which serve LMI communities. And it's an interesting, we should give some thought in our review how deposit insurance may play into this as well.
And I have many more questions, but we're going to work together on this, and my time has expired. Thank you, Mr. Chairman. I yield back.
The gentlewoman yields. The chair now recognizes himself for 5 minutes. Vice Chair Barr, did you originally believe that inflation was temporary and transitory? Yes or no?
I was not on the Federal Reserve Board at that time.
Did you believe it was temporary and transitory, or you had no opinion?
I would say at that time I did not have an informed opinion.
You did not have an informed opinion if it was temporary and transitory. The Federal Reserve continued to call inflation temporary and transitory until Q4 of 2021. The Biden administration continued to call inflation temporary and transitory. I apologize, the Federal Reserve Q4 of 2021. Biden administration Q1 of 2022, following the Russian invasion of Ukraine. That's when they stopped calling it temporary and transitory. Would the challenges that we saw with SVB have taken place if inflation truly was temporary and transitory? Yes or no?
The problems that came about from SVB are from classic interest rate risk management.
So if inflation was temporary and transitory, then I will make the assumption on your behalf, for myself, that interest rates would not have gone up. If interest rates didn't go up in the manner and hold in the way that they are, SVB would not have occurred. The breakdown of the bank.
Sir, banks have an obligation to manage interest rates, whether they're going up or going down. It's just classic good banking, and it wasn't done here.
Okay, so let me dive in then. Yesterday, in response to a question from Senator Rounds following the matter requiring immediate attention, the MRIA, you noted that there was a challenge in the model that it was, quote, was not at all aligned with reality, end quote. Was that a challenge in modeling in particular interest rates? Or what part of reality was it not connected with?
Let me also say, as I mentioned earlier today, I called that an MRIA yesterday, but I meant an MRIA. It was just a staff note mistake. But so it's an MRA on interest rate risk. And basically what I meant is that their model showed that they'd earn more money as rates were going up, and they were losing more money.
So interest rates was at the core of how it was disconnected from reality?
Yes, it was about interest rates.
That's fair. So here's my challenge. So as I look at the ability to prevent all of this, the Federal Reserve would have had to admit that they were wrong, that inflation was temporary and transitory. I think that's at the core of our conversation here in Congress. I think continues to do an abysmal job with the administration to bring inflation under control. Let me switch gears if I can, pretty substantively here, Vice Chair Barr. I have in front of me the H41 from the Federal Reserve, and in particular looking at the loans that the Federal Reserve has made to depository institutions. There's been a significant shift in particular as relates to other credit extensions. Other credit extensions is noted is that the Fed is taking collateral from the FDIC. That account, March 9, $0. March 16th, 1 week later, $57.6 billion. March 23rd, 1 week after that, $178.6 billion. So the Federal Reserve is taking collateral from the FDIC and loaning the FDIC money. Under what statutory authority is the Federal Reserve engaged in that?
Sir, the Federal Reserve is lending through the discount window to the bridge institutions that were established by the FDIC. So they're lending to banks. There's a provision in the statute that clearly contemplates that.
And so you're noting that when I read footnote 7, that would not have fallen under the line of either primary credit or secondary credit?
For the purposes of enhancing transparency to the public, that line was broken out so that everybody could see exactly what it was.
Okay, that is helpful. Then if I can shift to you, Chair Gruenberg, as we look at this dramatic increase, is there a reason that you used this facility rather than one, selling assets, or two, tapping your line of credit at the Treasury, which I believe is to the tune of $100 billion?
We certainly have sold assets to meet our liquidity needs, and these bridge institutions are nationally chartered banks eligible to borrow from the Fed and utilize that in order to manage the liquidity situation as well.
But is there a reason that you're not either A, utilizing in a more substantive way the credit line available from the Treasury, or B, selling assets? And the reason I ask this, so maybe I can be more specific, does the FDIC have the same risk that we're seeing in other banks with unrealized gain or unrealized losses? And is that why you're tapping this facility rather than selling assets?
No, we are Congressman, we are selling assets to meet the obligations of the failed institution, and we're also managing the liquidity. These bridge banks have the authority and ability to access the Fed resources.
So you're both selling assets and borrowing from the Fed to the tune of $178 billion at the same time?
For these institutions to meet immediate liquidity demands, which we'll eventually get back.
And did the Treasury at any time discourage you from taking a loan from the line of credit from the Treasury for purposes of addressing the debt ceiling limit?
I think there were discussions in regard to that, but I think the principal purpose here, frankly, was liquidity management and also to be able to preserve liquidity in our deposit insurance fund.
I appreciate your time here today. I yield back. I'll now recognize the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here with us today. People in my district are already living paycheck to paycheck, and they're worried about making ends meet. They're already dealing with the rising costs of everyday goods and services, and the last thing they need to worry about right now is their bank or their employer's bank failing. That's why I'm working to provide transparency and accountability to this process. Where were the regulators? I want to know what the bank executives were doing in the months, weeks, and days leading up to this failure. My constituents deserve to know that we're going to hold bank executives accountable and ensure that this doesn't happen again. These bank failures rattled our financial system. Working families in my district need a stable economy they can rely on. They can't afford more uncertainty when it comes to their next paycheck. And right now, the looming debate over the debt ceiling crisis has the ability to rattle our economy even further. So, Vice Chair Barr, in just a few months, the United States Congress needs to raise the debt ceiling. If the U.S. defaulted on the debt, would it be really bad for our economy? Would it be really, really bad for our economy? Or would it be really, really, really bad for our economy?
The basic answer to that question is that Congress needs to increase the debt ceiling, that there's not other options around that. In the absence of an increase in the debt ceiling, it could cause enormous dislocation to our economy.
So 1 really, 2 reallys, 3 reallys?
I wouldn't characterize it. I think that it's the right thing to do. I think Congress needs to do that, and really leave anything else about the debt ceiling up to discussions between the administration and Congress. Just to say, from an economic perspective, it would be quite unfortunate.
Thank you. Vice Chair Barr, the second largest banking failure in the United States history, $42 billion pulled in a day. Who was asleep at the wheel?
But I think in the first instance, as I've said, bank management is responsible for running the bank. They failed in basic measures of interest rate risk and liquidity risk. They had very many outstanding matters requiring attention, matter requires immediate attention. They were deficient in governance and controls. They were rated a 3 overall with respect to the firm, which means they were not well managed. And at the end of the day, it's the job of the bank and their board of directors to run themselves the way they should. We, of course, are looking internally at our own supervision and our regulation in looking at ways that we could have forced the firm to do more faster or raise standards so that if the firm got into trouble, they had more capital and liquidity.
I certainly hope there's some accountability. Chair Gruenberg, moving to you now. First Citizens Bank, which is located in my congressional district, North Carolina's 13th district, was a successful bidder for Silicon Valley Bank. They have a proven track record in this space and are already instilling greater confidence in our banking system. Can you tell us about the evaluation process for the bids that were submitted and what made First Citizens the most attractive bidder?
Two reasons I'd say, Congressman. One, financially, it was the strongest bid for the FDIC. And two, it was a bid for all the deposits of the institution and all of the loans of the institution, so that it provided operational certainty as well. So from both a financial standpoint and an operational standpoint, it was really the strongest bid we received.
And it took a while. You know, why wasn't Silicon Valley Bank purchased sooner? I think that certainly would have created more stability in this situation.
If we could have sold it that first weekend, that would have been desirable. The fact is, Silicon Valley was a pretty large institution, $200 billion in assets, and pretty complicated in terms of its business activities. So for a potential acquiring institution to do the due diligence over a weekend and reach a conclusion and make it was frankly not practical. And so we set up a bridge institution and for both of the failed banks, and we're able in a pretty orderly way to set up bidding processes for each. In fact, for Silicon Valley, we had considerable interest and got a couple of requests for additional time for interested parties to do due diligence. So we extended the bid date a couple of times to give people time, and we ended up, getting, I think, 27 bids from 18 different sources. So it ended up being a pretty constructive process.
Thank you very much. I yield back.
The gentlewoman from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Chairman. Let's examine what we're discussing here. At the time of its failure, Silicon Valley Bank was the 16th largest bank in the United States, with its assets more than tripling from $71 billion in 2019 to over $200 billion at the end of 2022. Obviously, we all know banks have its responsibility to manage its operation well. Unfortunately, our economy facing inflation not seen in decades and increasing interest rates, supervisory missteps at the federal and state level failed to correct and mitigate SVB's rapid growth in its balance sheet and management risks. Mr. Barr, yesterday you mentioned that you first heard about SVB's interest risk and liquidity management, those issues back in February of this year. So I want to ask you, who decided to put SVB under the horizontal review process, considering there were at least 6 warnings going back to 2021, and given SVB's risk profile, how did you conclude that the firm did not merit actions beyond the horizontal review process?
Thank you, Representative Kim. I think that's one of the things we're trying to figure out in the review. The supervisors on the ground saw the risk that you described, saw the interest rate risk, and saw the liability risk. They required the firm to make changes. The firm didn't make those changes in time. The concern of supervisors grew. You can see that from the fall of 21 to the deficiency rating in 22, and then further action that year. But you're absolutely right that at the end of the day, the bank failed, and so
Well,
we need
it
to look
seems
at.
to me, reclaiming my time, it seems to me that you could have considered downgrading ratings or considering enforcement actions. And to me, it seems that supervisors kicked the can down the road and couldn't consider the full consequences of the inaction. But I want to ask the next question. In February, the Fed reported in its January Senior Loan Officers Opinion Survey that it is seeing tighter credit conditions. So it seems to me SVB's failure will only serve to exacerbate the tighter credit conditions. So I'm worried that as entrepreneurs, they will soon find it more difficult to get a loan or credit to expand their businesses and hire workers due to tighter credit conditions. So, Mr. Barr, I want to ask you, how will you consider tighter credit conditions as part of your holistic capital review and Basel III endgame reforms?
So we're looking to review our capital requirements not for the current situation, but for the long term. Any capital requirements that we consider would go through notice and comment rulemaking and have a transition period, so they would not apply to the current economic circumstances that we're in. We're thinking about the long-term effects. We are, of course, paying attention to tightening credit conditions as part of our monetary policy decisions. Those factor into our forecast for the economy and therefore into our interest rate decisions.
Well, I'm asking you to please pause and keep the current market volatility and uncertainty in mind as you do that. Let me ask you, Mr. Gruenberg, a question. Yesterday, you stated that you received 2 private bids to purchase SVB. This is after the FDIC was appointed as a receiver, and you said one was invalid because it did not get the approval of the board. And the second one indicated it was more expensive than liquidation. So in your prepared statement, you mentioned that the cost to the Deposit Insurance Fund of resolving SVB will cost about $20 billion. Can you tell us why FDIC board decided to deny the first bid? And did you see the second bid as more expensive than the $20 billion incurred by the insurance fund?
Well, I think the point is that neither bid was less expensive than liquidation. So liquidation would have been a less costly alternative than either acquisition at that point. And frankly, the limited bids and the quality of the bids we received was a function of the very compressed time frame, because we just taken over the institution Friday morning, and this was Sunday afternoon, and we thought it was in the interest of the Deposit Insurance Fund to place the institution into a bridge so that we could manage it for a brief period of time and then organize an open bidding process so that interested parties would have a fair opportunity to bid on the institution. And that's ultimately what happened. And if it would be helpful, I'd be glad to respond in writing. I know.
That would be fantastic. And with that, we'll recognize Ms. Pettersen of Colorado for 5 minutes.
Thank you, Mr. Chairman. I am the last on the list, I believe, always am. So I just want to thank you all for being here today.
Well, we're members of Congress. We don't rate it that way. If we can restart our time. I'm sorry to interrupt. I apologize.
Thank you, Mr. Chairman, and I really appreciate this incredibly important discussion. There are numerous areas that need to be examined to better understand the failure of Silicon Valley Bank and Signature Bank. But first, I want to thank you and the boards of the FDIC and the Federal Reserve and the Treasury Secretary for your leadership and ultimately bringing the resolution needed to stabilize the banking system and protect depositors. I had text messages and emails and phone calls from constituents and from people across Colorado who were absolutely terrified that they were going to lose everything and that they were going to be unable to make payroll. So while the response took some time, and I think it did foster a lot of misinformation being spread, ultimately, thank you so much for doing what was necessary to protect our economy. But we're of course here today because we want to make sure that we're learning from what could have been done better and evaluating what we need to do in changing times. And I think that one of the most challenging issues that each of us face in this committee and for all of you is how we adjust our regulations and responses in a time when information spreads like wildfire, and in this case created a panic across our system and threatened our entire economy. Previously, a bank run would take days. In 2008, Washington Mutual saw over $16 billion in withdrawals over 10 days. With SVB, the bank run happened in a matter of hours, with a record $42 billion being withdrawn in a single day. And while SVB clearly wasn't managing their risk and was not listening to the warnings from the FDIC, I don't think any bank could have survived a run like this. And so, Mr. Gruenberg, knowing that this panic occurred through social media in response to the suggestion that not all depositors would be protected when the FDIC took over SVB, what lessons can regulators take from this to improve their public communication when a future bank fails, and knowing how quickly depositors can immediately move their money in this new technological age? And specifically, I know you're going to take time, and we'll hear a lot more about this in the future. What do you think is needed to expedite the responses necessary to mitigate something like this from happening again?
Well, to prevent it from happening again really raises all the supervisory and regulatory issues we've been talking about this morning. I do think in regard to deposit insurance, we should do more and perhaps a better job of explaining to the public how deposit insurance works, what is covered, what is not covered, what are the options available to people when they open a bank account. And I think that would also be one of the reasons to undertake this overall review of the deposit insurance system to see what changes might be considered that would be helpful to the public.
Great, thank you for that. And last, Vice Chair Barr, in just a couple of weeks, we've seen these two bank failures. We've seen efforts to prop up First Republic Bank, and we've also seen issues with Credit Suisse and the Deutsche Bank in Germany. I'm still getting questions from people in my district who are concerned. And so what message do you have for them, for our constituents and small businesses, to reassure them that our financial system is stable and that their money is secure?
Well, I think that's an excellent point. I know when many of you talk to banks, in your own in districts, they're telling you the same thing, which is that banks are sound and resilient. I think if you look at the actions we took a couple and a half weeks ago, those actions demonstrate that we're committed to ensuring that all deposits are safe. We're prepared to use those tools for any size institution as needed, if appropriate, to keep the system safe and sound. So the basic message is that the banking system is sound and resilient.
Great, thank you. I really appreciate it. And I yield back, and congratulations, since I'm the last one.
Gentlelady yields back. The last one on the Democratic side. So panelists don't get too excited. We'll now have...
We have two.
Oh, we have two? I'm sorry, Chairman Meeks. I'm very sorry. That's not getting better news for you guys, sorry. We'll now recognize the gentleman from Florida, Mr. Donalds, for 5 minutes.
Thank you, Mr. Chairman, panelists. I know it's already been an interesting day. Thanks for being here. Vice Chair Barr, says here you were confirmed July 19th, 2022. So you came in kind of in the middle, according to your own testimony, of when the San Francisco Fed was having examinatory issues at SVB. Is that fair?
The examiner report with respect to the whole firm as a whole was done in July 2022, and that's when I arrived.
Okay. According to your testimony, you say here at the end of 21, supervisors at the SF Fed found deficiencies with bank liquidity risk, resulting in 6 supervisory findings. In May of 22, there were 3 additional findings associated with ineffective board management, et cetera. In October of 22, supervisors met with the bank's senior management to express concerns about the interest rate profile. In February 23rd of 2023, your staff alerted you to these issues, and then we know the rest of the story. Is it your assessment that there are serious supervisory issues at the San Francisco Fed?
We're doing the review of that now, and I don't want to prejudge the outcome of it. There were clearly supervisory
Mr. Barr, I'm not going to
failures.
ask you to prejudge. I'm going to prejudge. As an American citizen, as a member of Congress, don't you think it's it is a rational judgment that if all these supervisory findings were existing for the last 2 years and this still resulted, that there are supervisory issues at the San Francisco Fed?
Sorry, was that was a question?
Yeah. Do you think it's a good assumption to make?
I don't want to assume. I want to go look at the facts. We're going to go look at the facts in this review. I think that overall, at the Federal Reserve, without pointing any fingers in any direction, that there were significant supervisory failings. I said that at the outset of the hearing, that if you have a bank like this that's failing, there are serious management issues, there are supervisory failings, there are regulatory failings, and we're committed to looking at all of those.
And that's fair. Let me throw this out to you. Mr. Chairman, for the record, I want to put into the record, Wall Street Journal article dated November 11th, 2022, rising interest rate hikes, hit bank bond holdings. In this article, it is actually a comment in here by Thomas Honig, former president of the Federal Reserve Bank of Kansas City, former vice chairman of the FDIC, and he says if they go high enough, you can actually be losing money on those assets. He was generally speaking about banks, but not specific banks. This is highlighting that his concern, somebody who was in your shoes and Mr. Gruenberg's shoes, was concerned about rising interest rates on bank portfolios writ large. Do you agree with that statement?
Yes, I think interest rate risk, again, is a core risk. We look at it across the system, and banks are supervised for that. It is absolutely essential they manage that risk.
Mr. Barr, let me ask you a question. Do you think that this committee should be talking to SF Fed President Mary Daly? Do you think that she would have some color on these issues that happened at Silicon Valley Bank?
I think, the committee's decisions about witnesses is far outside my expertise.
Let me ask you this question, because actually we've been talking a lot about concerns from a supervisory perspective. You have a speech dated March 9th, 2023 at the Pettersen Institute for International Economics here in DC. March 9th is an interesting day. That's the day that SVB blew up. In your speech, you say, the banks we regulate in contrast to stable coins and crypto markets, are well protected from bank runs through a robust array of supervisory requirements. You still stand by that statement?
As I said earlier in the hearing, I think that it demonstrates the need for humility about our ability to understand the causes and consequences of financial difficulties. So, of course, that statement in this context is turned out to be incorrect.
Okay, that's fair. Let me ask you this, one last thing. And Mr. Chairman, for the record, I also have another article I want to submit. The U.S. needs a new bank supervisory system, written by Peter Waleson, who is at the American Enterprise Institute. And in part, it talks about some of the shortcomings of the current supervisory system. In short, I will say this in the final 22 seconds of my testimony. It's been for the last 14 years in Congress, we view Dodd-Frank as the holy grail for safe and sound banking. And if we're going to be honest with ourselves, what has been the holy grail for quote unquote safe and sound banking is cheap or free money for balance sheets to look good. But when rates rise, not all balance sheets look good. And that's not just banking, that's in a lot of places. So maybe we should take a look at our supervisory system overall. I yield back.
Gentleman's time has expired. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
Thank you to the chairman and ranking member and to the regulators for appearing before the committee. I want to start by saying the work that was done to address the Silicon Valley and Signature Bank collapse and ensure the health and resiliency of the U.S. banking system is vital. And I want to commend those that were involved in the swift action and the decisive steps that were taken to protect businesses' payroll, particularly small businesses and their employees who we heard from at that time. Now, while depositors were protected, shareholders and bondholders need to bear the cost for any potential mismanagement. And I'm eagerly awaiting the full examination of these bank reviews and the upcoming reports that you will be providing. Now, while the collapse of the Silicon Valley and Signature Bank may have occurred due to unique and isolated factors, the panic that their failures caused quickly became a private or a sector-wide issue. And I'm glad to say that the original crisis of confidence was subsided and cooler heads did prevail. I fear that the consequences will continue to materialize as we go on. For example, consolidation of deposits within the largest systemically important banks will only continue if the sense of risk within the financial system persists. Uninsured depositors are leaving our mid-sized banks because they feel that their money is safer elsewhere, even as these banks showed continued strength and sound financial footing. Deposit insurance is crucial for many of my constituents to get a sense of peace of mind, and we cannot have the perception of a two-tiered banking system in this country where only the largest banks are protected. So, Chairman Gruenberg, as we look to increase confidence in the banking system with a particular focus on small and medium banks, how would an increase in the FDIC insurance limit prevent further consolidation of deposits at the largest banks?
Well, I think, Congressman, I think that question is raised by this episode. The decision to guarantee the uninsured deposits of these two institutions really have implications for the entire deposit insurance system, and we need to consider it. And I'd like to do it comprehensively, looking at all the aspects of our deposit insurance regime, and then come back by May 1 with a report that the FDIC will put out, which will also provide some policy options for consideration.
All right, one other area that I'm concerned about, I've already heard multiple development projects, particularly housing projects in my district that are struggling to get financing due to a pull back of credit from community banks. While I understand the need to review capital requirements, I think you'd agree, Vice Chair Barr, that no bank can meet $40 billion plus in depositor demands from capital alone. So, Vice Chair Barr, I would really urge you to consider the effects of increased capital requirements on the lending of healthy community banks. However, I do believe that action must be taken. So would you be able to discuss any additional strategies the Fed would be able to pursue to address the problems that we have seen at Silicon Valley and Signature banks without reducing credit industry-wide?
Thank you very much. First of all, the capital review that we're doing does not apply to community banks. We're not intending to increase capital requirements on community banks. My understanding from looking at the community banking system is that it is well capitalized and stable and is serving its communities. We are looking at larger institutions. If we do that, we're going to do it through a notice and comment rulemaking process. That takes a good bit of time, and there are transition rules. So we're not talking about capital rules that in any way that would apply now. We're talking about how to make sure that the capital and liquidity rules in the future are appropriate.
Okay. And then finally, there were reports that after Silicon Valley went into receivership, they literally advertised that their FDIC guarantee as a way to attract depositors. Is that true? And if so, what's being done? They cannot now benefit from the policy after we helped save them.
That's a fair question, Congressman. We placed Silicon Valley into a bridge institution. There may have been some communications of the kind you described. When we heard about it, we put an end to it.
Thank you. Thank you, Mr. Chairman. I yield back.
Gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, you've disclosed that Silicon Valley Bank's composite CAMELS rating was a 3 out of 5. In response to Ranking Member Waters' question earlier, you disclosed that their liquidity rating was a much stronger 2 out of 5. Furthermore, you testified that the Federal Reserve examiners cited Silicon Valley Bank 7 separate times, and you testified that examiners were aware of Silicon Valley Bank's interest rate risk last year. Why wasn't that risk reflected in Silicon Valley Bank's liquidity rating?
I think it's an excellent point. One of the things we're looking at the review is, given the extent of difficulties, the problems the firm was having, how did the regulators come up with this particular, the supervisors come up with this particular approach? Its composite rating was not well managed, and its holding company rating was deficient, that is also not well managed. But it has a 2 for liquidity and it conditionally meets expectations for liquidity. And so we're trying to understand how that is consistent with the other material. I mentioned earlier, too, that I'm highlighting the liquidity and governance and interest rate risk findings, but there were many other findings at the firm that had not been addressed at the time they failed. And so the question is, why wasn't that escalated and why wasn't further action taken? I think it's a legitimate and fair question.
Was that composite score, that composite Camels rating, ever downgraded in 2021 following the examiner's citations?
I don't know the answer to what happened in 2021. The 2022 rating was the first time the firm had a composite rating for all of its activities as it entered the large and foreign banking organization group.
Vice Chair Barr, was Silicon Valley Bank's liquidity rating ever downgraded following the examiner's citations in 2022, or is that the same issue as you just described with the large bank status, their liquidity rating?
The overall rating for the firm, of which this would be a part, was done that summer. There was a process after that of looking at both liquidity risk and interest rate risk. And my understanding is, as part of the horizontal review that was being conducted at the beginning of 2023, the examiners were looking at, what was the appropriate level.
Okay, every quarter, the FDIC releases its quarterly banking profile. This profile includes a public disclosure of the total assets of FDIC-insured institutions that are deemed, quote-unquote, problem banks. In December of 2022, the FDIC's problem bank list included total assets of only $47.5 billion. Although the banks on the FDIC's problem list are not public, given the size of Silicon Valley Bank, it's reasonable for me to conclude that Silicon Valley Bank was not on the FDIC's problem bank list, released just 3 months before its collapse. Mr. Chairman, given the several supervisory findings identifying various issues with Silicon Valley Bank's practices since 2021, including the issuance of matters requiring immediate attention from those supervisors, were those findings communicated to the FDIC?
I can tell you, Congressman, that the criteria to get on the problem bank list is to be rated a 4 or 5 on the Camel's rating scale of 1 to 5. And at that time, Silicon Valley was not rated a 4 or 5, so we wouldn't have been in a position to put it on the problem bank list.
Vice Chairman Barr, why wasn't this information shared for the purposes of the FDIC's problem bank list?
As Chairman Gruenberg just indicated, the FDIC makes an independent judgment with respect to its list based on the ratings of the firm, and the firm was not rated lower than a 3.
Chairman Gruenberg, has Silicon Valley Bank ever previously been on the FDIC's list of problem banks?
The reason I hesitate is we put the aggregate assets of the institutions on the problem list. We don't indicate the individual institutions.
Here you can do that.
No, I take your
and
point.
This is a question from Congress.
Yeah, well, I believe I can come back and answer your question. If I may, we follow up for the record, but be glad to do that. I just want to check, but yes, the answers will come back with an answer.
The answer is yes?
We will come back with an answer for you if that's okay.
Okay. Thank you for your testimony. I still think there are lots of questions regarding what happened here, especially with Silicon Valley Bank, and I appreciate your time. I yield back.
I'll go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Let me thank all of you for your responsibilities and the duties and what you've done. It's funny when you've been here for a while, a lot of folks are here talking about Dodd-Frank shouldn't be the golden rule, but if you were here in 2008 when there was no Dodd-Frank, that was a crisis. That was something, this is nothing, I wish some of my colleagues who are here, who were not here, we are a long way away from where we were in 2008. And the bank's system is much stronger now than it was 2008. And I say, thank God that we had Dodd-Frank at that particular time. So I want to thank you for that. But as a result, let me just ask, maybe Vice Chair Barr, as part of your internal review, you've indicated that you plan to evaluate whether the application of more stringent standards would have prompted SVB to better manage risks. So as part of that, do you expect to look into whether more frequent stress testing for a bank of SVB's size would be appropriate?
Yes, Representative Meeks, we'll look at stress testing. We'll look at really all the enhanced prudential standards, liquidity standards, capital standards, stress testing. All of that will be part of our review with respect to SVB, and it'll help inform broader questions we've been working on since I arrived in July about what the capital framework for the system should look like.
Now, are stress test results for our largest banks, those that are above $250 billion, they are available to the public? Is that not correct?
Yes, the stress testing results are available annually to the public.
And I understand that because of SVB's rapid growth and the timing of when the bank crossed the $100 billion asset threshold, SVB would not have been subject to stress testing until 2024. But when a bank with about $100 billion in asset size is subject to stress testing, who has access to those results? Would, for example, an individual or small business client of the bank be able to see those results?
So under the current framework you correctly described, the Federal Reserve's rules established in 2019 would provide that SVB would be subject for the first time to stress testing in 2024. There is currently, under that structure that was put in place in 2019, no stress testing for firms below the 100 billion level, and that's part of the framework.
So could you expound a little bit more on how helpful it might be for a depositor, for example, to get to see those results, especially depositors who are uninsured, that have uninsured deposits?
So stress testing results for the firms that are in stress testing are published annually. For firms that are below that level in the current framework, they're not required for that kind of stress test. They do internal liquidity stress test as a normal part of their requirements on a quarterly basis. That's an internal proprietary action by them, subject to supervisory review. In the case of SVB, they conducted their liquidity stress test, but the supervisors found that those stress tests essentially were not stressful enough. They were not realistic.
So, I mean, that's, but I believe there's an issue that customers and investors who bank with institutions that are large enough to have triggered a systemic risk exception do not have the transparency into the risk management and scenario plan that their banks may have underway. But in the limited time I have, let me just follow up on a couple of questions that some other people had asked. I am thinking about small banks and community banks, which are very important, and talking about depository insurance, and I know someone was talking about that. Now, to me, not a lot of people, especially in the community banks, have $250,000 in the bank. So this would, but in trying to help strengthen those banks, what I would like to see is some of the small businesses may have more than $250,000 in the bank, and they have to pay employees. And I would like them to be giving them some business. So do you think that, and I don't know, but that there should be some, when you look at depository insurance, a difference between small businesses and personal, as far as that's concerned going forward?
Congressman, that's a good question, and it's one of the things we'll be looking at in the report that we're going to submit on May 1 and laying out some policy considerations to take into account here.
Thank you. I'm out of time, so I'll yield back.
Another gentleman from New York, Mr. Lawler.
is recognized.
Thank you, Chairman. Chairman Gruenberg, just to follow up on that line of questioning, yes or no, should the FDIC insurance limit be raised?
Let us do the work on this and then come back to you with a report.
Well, in the 2008 collapse, we raised it from 100 to 250,000. We made it permanent in 2010. It has not been raised since then. Do you think it should be raised?
I don't know the answer to that question right now, Congressman.
Okay. Did the Fed, the FDIC, and the Treasury have the tools needed to deal with this crisis when you were made aware of the situation with SVB? Do you all believe, yes or no, that you had the tools needed to deal with this?
Yeah, yes, we have the tools we need.
Yes?
I agree, yes.
Yes?
I agree, we had the tools to
Okay.
prevent a
Did the Fed, the FDIC, and the Treasury have the tools needed to prevent it? Yes or no?
I think that's a very difficult question to answer. I don't have a yes or no answer for it. I think we can do better at supervision and regulation, but whether we could have prevented the collapse in 24 hours of this institution, I don't know the answer to that.
I agree with Michael's point, but from a supervisory basis, I think there was an opportunity.
I'm sorry, Congressman, can you repeat your question?
Yes or no, do you think the Treasury had the tools needed to prevent this from happening?
The Treasury had the tools to use the systemic risk exception
And used it?
and recommendation to prevent a crisis.
So the FDIC and the Treasury do believe it. The Fed, not sure yet. But so in that case, do you think the Federal Reserve failed here in its role?
I think fundamentally, as I've said, it's the responsibility of bank management to run the bank. The bank managers failed in basic risk management.
Right, but you provided, the Federal Reserve and the San Francisco Fed provided guidance, provided notices, and failed to follow up on that, correct?
I would say that there was follow-up. The question is whether the follow-up was stringent enough, and that's part of the review we're looking at.
But stringent enough really means that the individual people may or may not have done the job that they were supposed to do, correct? Because if you give the notice and you reach out, isn't it incumbent on the individual supervisors to actually follow up and make sure that the bank is doing what it needs to do?
It's incumbent on the bank to take the actions that the supervisors are directing them to take, and it's incumbent on the supervisors to check on that.
Did the supervisors fail to check on that?
No, I didn't say that. What I said is that it's incumbent on the supervisors to do that. I think it's a legitimate...
Did they do that?
I think it's a legitimate and fair question to ask whether they were stringent enough, whether they used enough tools to force the bank managers to do what was obviously right.
With respect, that is semantics. Did they do the job they were supposed to do? Did they follow up?
The reason I'm having difficulty answering the question is I believe they did follow up, but the bank managers did not perform on the job, and that's why we're looking...
Were California and New York regulators equipped with the appropriate tools to handle this? Or should these banks, specifically SVB, given their size, been federally chartered instead of state chartered?
I think that our country benefits from having a wide diversity of kinds and sizes of institutions and the diversity of chartering authorities that we have, so I'm not recommending that we change that.
Okay. When did any of you first speak with Superintendent Harris regarding Signature Bank? Just date, please.
I'd want to check the record on that. If I may, I will come back to you. I just want to be sure we're accurate.
Okay. Do either of you know when you first spoke to Superintendent Harris?
I do not. I mean, Signature Bank is an FDIC in New York state-regulated institution, but I don't know when I first had a conversation about it.
Okay. Chairman Gruenberg, when was the decision made to close Signature Bank, and what criteria were used to determine whether or not Signature Bank met the systemic risk exception?
Those are two questions, Congressman. The decision to close the bank is the authority for the state, and the state made that decision on Sunday. And what was the question in regard to the systemic risk exception?
What criteria was used to determine that?
Oh, I think we had before us the failure of two institutions, both Silicon Valley and Signature, and we also had before us evidence of significant liquidity stress at other institutions, and we had data in terms of deposit outflows, and I think that was basically the data we relied on in making this judgment.
If the chair will submit that data for the record and answer for this,
Yes.
would you be willing to do that? The data.
Yes, of course.
Related to systemic risk designation.
Yes.
Okay.
Thank you,
Or
Mr.
systemic risk event. We'll now go to the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Thank you, Mr. Chair. Thank you for being here today. If you would just, with a show of hands, do you believe that, as most Americans do, as I've said and as the President said, that taxpayers should not be on the hook for that? Would you agree with that statement?
Yes.
Further, would you agree with the statement that we should have diversity within our banking system?
Yes.
Yeah, I agree.
Specifically, then, would you be supporting our regional banks, our small local banks, and recognize the undue burden that they potentially are going to be saddled with as a result of a FDI assessment because of these two banks?
As you may know, Congressman, I responded to that issue, and the answer is the FDIC has authority under the law to consider who benefits from the assistance provided, and we'll take that into account with particular attention and sensitivity to the impact on community banks.
I appreciate that, Mr. Gruenberg. I want to specifically talk to Mr. Barr here. For the diversity in banks, when you do your holistic capital review of banks under $10 billion, what would that look like?
We're not anticipating in any way raising capital requirements with respect to community banks. It's not part of my holistic review.
Good. I'm glad to hear that. Second, I'll highlight here $22 billion, as we say in Iowa. That's a lot of money. And in fact, it's 20% of the entire FDIC's fund for this. In order to make that up, special assessments will inevitably have to be part of this. Do you see that being passed along to the top banks primarily, or how will you calibrate that?
Well, Congressman, it's relevant to my response before. We're required by law to pay for any cost to the deposit insurance fund caused by the coverage of the uninsured deposits through a special assessment. We have to do that by notice and public notice and rulemaking, and we have authority under the law to consider the types of entities that benefit from any action taken or assistance provided.
So I understand that, but I just want to highlight the difference here. We had two banks that had 90% of their depositors uninsured at any level, and most banks across America are at 47%. My state of Iowa, in Des Moines alone, it's 70%. And my rural guys, it's 7%. I mean, these are farmers who are looking to plant this spring who know that they have a good deposit there. It's small businesses that are supported by this. What they don't need is ultimately, to my original question, an increase on their cost of living, on their cost of doing business by a special assessment that disproportionately punishes those who are at the medium and small size. Are you committed to making sure that's a priority for you?
Yes.
Excellent. Last question. I want to be brief here. Silicon Valley Bank did not have a chief risk officer, Mr. Barr, for how many months?
I believe it was approximately 8 months.
So almost a year. During that time, they did have 4 members who served on something called the Governance and Corporate Responsibility Committee. And these 4 members were actually on their risk committee, but had no, as I understand it, actual experience in managing material risk. Were these individuals focused on the wrong thing, and was there no true risk management being taken at Silicon Valley Bank in the lead up to the fail?
I can't speak to the particular individuals. I can say that the supervisors told the board of directors and the bank that the board oversight with respect to risk management was deficient. That was one of the findings that was made in the summer of 2022.
So then, did beginner risk management of interest rate risk and liquidity risk cause this bank to fail, SVB specifically?
Yes, ultimately, they mismanaged their interest rate and their liquidity risk, and their very large percentage of uninsured depositors had a massive and unexpected run, as I said, $42 billion on a Thursday, and expected another $100 billion on Friday, and that was just a devastating run for the institution.
So I'd like to ask this question then, and I hope that Mary Daly has the opportunity, Mr. Chair, to testify in person before this committee. But as you're overseeing this, why did she tout the regional Fed's work on cataloging climate risks, even going so far as to assemble a team to study how these risks are likely to impact the Fed's future reserve mandates? And I'll state here that one of SVB's memos from their supervisory credit group claimed they had been working closely with the Fed to inform its agenda priorities, namely fiscal risk to banks from climate change. Were the regulators focused on the wrong risk posed by this administration? Yes or no?
The supervisors were focused overall on the system on interest rate risk, credit risk, cybersecurity risk, traditional risk in the banking system. There are some supervisors who are focused on climate change.
But there was no risk officer to look at the actual dramatic overage that they had at this.
I'm sorry, you're talking about the bank risk officer?
Thank you, Mr. Chair. I yield back my time. I'll submit the rest of the questions independently.
Gentlewoman from Texas, Ms. Dela Cruz is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, witnesses, for being here today. What we've learned in the wake of the first run on a major U.S. bank since the Great Recession is that the management team of Silicon Valley Bank took, quite frankly, foolish actions that no informed financial institution should ever make. Now, by taking on deposits from their customers, which is short-term in definition, and buying long-term bonds when interest rates were low, now that is before President Biden's inflation crisis, they chose to become vulnerable. When inflation skyrocketed after enacting the Democrats' partisan $2 trillion American Rescue Plan, the Fed was late to determine that inflation wasn't transitory, forcing a decision to spike interest rates, creating risk in the banking system. Now, if we backtrack for a second and look at what the Federal Reserve was focusing on when they were hiking interest rate, it wasn't the risks associated with those actions. Instead, it was research papers on climate risks and social issues, which you just acknowledged a second ago that some were focused on climate change. My question is to you, Mr. Barr. I realize you didn't come into your role until July 2022, but isn't it correct that when you did, you quickly announced your holistic view of Fed regulations and your own Fed special scenario analysis for weather and climate risks?
Those are a few different items. I announced that I was doing a holistic capital review, which was looking at capital in the system, whether it was at appropriate levels. We've been conducting that really since July. There's a separate thing, which is that in the beginning of this year, we piloted for the globally systemically important banks, GSIBs, a pilot of climate scenario analysis to evaluate how they were addressing climate risk in the system. That's separate from basically what most supervisors are doing most of the time, which is highlighted in our November 2022 supervision report, which is looking at interest rate risk, credit risk, liquidity risk in the system.
Which we could both agree that interest rate risk, liquidity risk are within your job scope, but is climate risk really something that you should be focused on when we saw all of the red flags on this bank? Now, correct me if I'm wrong, but isn't the role of the vice chair for supervision to focus on bank supervision and regulation? Yes or no?
Yes, that is in fact what I am focused on.
So if that's the case, then were you distracted from the mission of your role, which again is supervision and regulation, and instead focused on climate?
No, I would disagree respectfully with that. The way that we're looking at climate risk is about the risk that climate change might pose to the financial system and to individual banks. It's a very narrow role focused on financial risk, not climate policy more generally. And I think, as I was saying before, we need to be humble about regulators' ability or banks' ability to understand all the risks in front of us. It's prudent to look at long-term risks as well as really obvious and central risks right in front of us, like interest rate risk and liquidity risk.
Well, I would say that what we saw with Silicon Valley was obvious risk. It looks like the mismanagement, it was flagged. There were fair warning signs. And while I appreciate that you were able to focus some attention on the actual supervision part of the bank regulation, we see a gap here. And I think that we would like you to focus on your job as the Vice Chair of Supervision in the wake of SVB's collapse. And I feel like this was a little too late when you all finally stepped in to look at it. So thank you. With that, Mr. Chair, I yield back.
We'll now recognize the gentlewoman from Indiana, Mrs. Houchin.
Thank you, Mr. Chairman. We are here today to really determine who knew what when, who did what when. Is this a failure of Silicon Valley Bank? Is it a factor of lack of adequate oversight or lack of regulation? I'm happy to hear many of you testify today in admission it was largely a factor of lack of oversight. We've heard discussions today about FSOC, the Federal Stability Oversight Council. Vice Chair Barr, what's the purpose of FSOC?
I'm sorry, the question is, what is the purpose of FSOC?
What is the purpose? What is the mission of FSOC?
The FSOC is an entity that brings together regulators from around the financial system, market regulators and bank regulators, to look at risks in the system and to try and coordinate across those agencies.
Right. So it was created by Dodd-Frank in 2010 to provide, according to FSOC's website, comprehensive monitoring of the stability of our nation's financial system. It's chaired by the Secretary of the Treasury. It includes the Fed, the OCC, CFPB, FDIC, CFTC. In fact, all of our witnesses today take part in those meetings. Do you not? Yes or no?
Yes, each of the three of us participate in FSOC as member agencies.
And the function of FSOC, is it also to identify risk to the financial stability of the United States? Mr. Barr, yes or no?
Yes, that is among its functions.
Following an executive order by President Biden in May of 2021, entitled Climate-Related Financial Risk, FSOC now also evaluates climate-related financial risk. Is that right, Mr. Barr?
That predates my time, and we're not in charge of running the FSOC, so I don't know the sequence of events, but it is the case.
I assume that it is now part of FSOC's charge to monitor and evaluate for systemic risk also?
I'm sorry, I couldn't hear the last sentence.
I assume it's also part of FSOC's charge to monitor and evaluate for systemic risk.
Yes, that, as I indicated previously, is a core function of FSOC, is to look at risks across the financial system.
In a quick review of the FSOC meeting minutes dated December 16th, 2022, 5 pages were devoted to, quote, climate-related financial risk. Mr. Barr, many of those comments came from you. I couldn't find any pages devoted to market and news reports of the apparent looming problem with Signature Valley Bank and Signature Bank. In fact, in December of 2022, Signature Valley Bank was listed on the S&P Global Marketplace as the top U.S. bank by proportion of uninsured deposits at nearly 94%. Only 4 other banks were estimated to be above 80%, including Signature Bank, but none of that was mentioned in your December 16th meeting. Are those factors not important to comprehensive monitoring of the stability of our nation's financial system, Mr. Barr?
I was asked at the meeting you were describing to discuss one risk to the financial system, and that was with respect to climate risk.
Let me just ask that question one more time. Are those factors not important to the comprehensive monitoring of the stability of our nation's financial system? The debt ratio, the uninsured ratio, is that not important?
The standard factors we think about in banking, among those factors are interest rate risk and liquidity risk. Those are core issues that we do in the bread and butter supervision every day.
So do you not consider the uninsured ratio as part of a factor of systemic risk?
We look, with respect to microprudential supervision of individual firms, we're looking at their liquidity risk. And one element of their liquidity risk is the extent to which they rely on uninsured deposits. That includes uninsured deposits from financial entities, uninsured deposits from operating businesses, and then their insured deposit base. So it is a core part of what we think about when we think about liquidity risk.
But none of that was discussed in the December meeting relative to Signature Bank or Silicon Valley Bank or any system gap.
As I said, the specific request to me in that meeting was to talk about this issue. We obviously talk about broader
Many other
issues all the
issues, yeah,
time.
I get that. Secretary Liang, earlier Chairman Huizenga was asking about the minutes taken at the meetings for FSOC. You said the meeting minutes are published after the next meeting. However, it seems there's more detailed information than what is shared publicly, and that the closed executive session meeting minutes are not shared at all. Will you commit to providing this committee with unredacted minutes from every FSOC meeting since the March 10th meeting, including closed executive sessions?
Congresswoman, I'm aware of 2 FSOC meetings since these events, March 12th.
Will you
and
commit to
March
providing the
24th.
meeting minutes for the executive sessions?
They were executive sessions, and we do produce minutes, and we will release them.
Thank you. I yield back.
We'll now go to our final 2 questions. So the penultimate questioner, Mr. Ogles of Tennessee, is now recognized for 5 minutes.
Well, good afternoon, and thank you for being here. I know it's been a long day. I'll try to be brief because I know you guys have to be exhausted. You know, Mr. Barr, when you look at increasing interest rates, especially in a rapid environment, is that going to create risks when it comes to deposit structure for these, well, really any bank, but certainly as it pertains to small and mid-sized banks?
As interest rates change, whether they go up or down, they create risks for banks, and the expectation is that banks manage those risks, and most banks in the country do manage those risks quite effectively.
Now, the regulatory regime that's in place, do they give specific guidance as it pertains to those risks in a rapidly changing environment?
We do have standard guidelines that are issued to banks about how they conduct their internal liquidity stress tests. Those tests are supposed to be designed to stress stressful environments with significant increases and decreases in interest rates. So they're not directionally guided. They're supposed to test up and down.
Well, as far as some of the guidance that was given specifically to SVB, and I think my colleague from across the aisle said they blew you guys off, what types of guidance or alerts were given to SVB?
So Silicon Valley Bank was required to conduct internal liquidity stress tests on a quarterly basis once it reached a certain size. It conducted those tests, and the guidance back from the supervisors was that the tests were inadequate.
Now, so understanding that you have a bank that grew rapidly in a very short period of time, there was even a Wall Street Journal article dating back to November 11th of 2022, singling out SVB's potential risk to the banking system. So clearly it was on people's radar. At any point, I think you stated earlier that you need further regulatory action from this body to further give you teeth, if you will, as you move forward. Did you ever request a hearing on SVB of this committee of jurisdiction, understanding that there was potential risk in the market?
Representative, I haven't asked this body for additional authority. I said we were conducting a review of our existing authority to see where we could have done better on supervision and regulation.
Well, when I think about this situation, and I think about my district, which is although it has part of Nashville, it's predominantly suburban and rural. What's going to end up happening is my small banks, my community banks, are going to end up bailing out a couple of banks that are too large to fail. And so I'm curious, Mr. Gruenberg, if my banks receive an assessment from the FDIC and they decide to blow you guys off, is there going to be some sort of regulatory action? Are you going to send them a bill? Are you going to enforce that assessment?
Well, Congressman, and this has come up previously, we're required by law to the extent there's losses to the Deposit Insurance Fund as a result of the coverage of uninsured deposits to impose a special assessment on the banking industry. And we're required to do that through a notice and comment rulemaking process. Right. And as I indicated, we also have authority.
So I guess to the heart of the question, though, is would you go to the bank and say, we want our money? Yes or no?
The answer is, if they were subject to the assessment, the answer would be yes. We do have authority to consider the types of entities that benefit from any action taken or assistance provided.
Well, see, the thing that's important here, though, is I've got to go back to my district and tell my banks they're not going to get screwed over in this process. And what I've heard today is a bunch of tap dancing and no assurances to my district and my banks that they're not going to have to bail out basically the failures of the regulatory bodies that were empowered to do a job. And if you found yourself unable to do that job, you could have come to the committee jurisdiction and asked for support. But I find no evidence that you did so. Mr. Chairman, I yield back my time.
Gentleman yields back time. We'll now go to the ultimate questioner, the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Mr. Chair. Yeah, I've heard that the same question asked 100 different ways over 2 days. The thing that I'm concerned about is it seems like a bank, shutting down a bank is messy. And I'm not sure if we're nimble enough or if the Fed or the FDIC is nimble enough that if we have multiple institutions that are all failing at the same time as to whether or not we could address this, because there seems like a 3-day period in which everybody was kind of making arbitrary, I'll say arbitrary decisions, not necessarily guided by any specifics. And if there is a table of specifics on what is the red flare that says this bank is in trouble, we need to act quickly, I'm not convinced after 2 days of testimony that that actually happened that way. So I would ask either one of you to first comment on, can you instill more confidence that in fact we do know what we're doing and we can react quickly, and if it is multiple banks, that we're going to be in a good place. And then I have one more question after that.
Well, I can say in regard to Signature that they basically ran out of money to meet their obligations, and that was the reason the bank failed. As I indicated earlier, they barely met their obligations at the end of the business day on that Friday, and it was clear to the state regulator, New York State, as well as to us, that they could not open on Monday and get to the end of the day based on the liquidity they had, and that was the reason the bank was closed by the state. And I'll let Vice Chairman Barr speak to Silicon Valley, but it was a pretty straightforward decision and a traditional one.
Mr. Barr.
Similarly, Silicon Valley Bank basically was unable to meet its obligations in the ordinary course of business. They suffered a devastating run, a $42 billion run on Thursday. On Friday, they expected to face a run of $100 billion, and they did not have the collateral sufficient to support discount window letting, and so they were not able to meet their obligations, and they were closed.
And then the last question or comment, I'll just, Ms. Liang, when were you informed, first of all, that there was a possibility of Silicon Valley Bank defaulting? And was the president made aware of that? How much conversation was happening within the White House? And were there conversations with specific depositors or those that had an interest, like Governor Gavin Newsom in California? And now I further learned that the state makes a decision on actually shutting down the bank. What were those conversations like, and could you characterize them for me?
So I learned, Treasury learned, or I learned, I can speak for myself here, of the issues at Silicon Valley either Wednesday evening or Thursday after it issued its statement, its earnings report, saying that it had a loss and was going to raise capital. We heard certainly Thursday night of concerns at the institution because of the very, very rapid deposit withdrawals. And then on Friday morning, we learned the California state regulator had closed it, and the FDIC was appointed receiver. We did, that was our situation. Over the day of Friday and Saturday, we heard from many people, institutions, businesses, wondering how they could access their deposits, could they make payroll, and so we were gathering information and consulting regularly with the Federal Reserve and the FDIC. So that by Sunday, we could
did
make
you
a
speak to
decision.
Governor Newsom at any point?
I did not.
Did anybody at the White House talk to Governor Newsom?
I do not know.
Okay, thank you. I yield back.
Gentleman yields back. With prior agreement between the ranking member and the chair, I'll now recognize the ranking member for such time as she may consume, and then I'll close.
Thank you very much, Mr. Chairman. Chairman McHenry, I thank you for working with me on holding this bipartisan hearing, and I look forward to additional hearings on these bank failures. Importantly, we need to hear directly from the CEOs of SVB and Signature Bank. I also want to thank our witnesses and their staffs for the countless hours they've spent since the failure of SVB and Signature Bank. The economy is stronger today because of your decisive actions. I look forward to hearing from you again when you have completed your review of the bank failures, and I expect those reviews will consider the various matters raised by myself and committee members here today. In listening to the concerns of members on both sides of the aisle, I must say I'm heartened by how much agreement there was. I heard Republicans argue for our bank regulators to be more aggressive in their bank supervision, to do more on-site exams, escalate penalties more quickly, apply enhanced prudential regulations for all banks over 100 billion, expand deposit insurance, and protect community banks from bearing the burden of these bank failures. I and my Democratic colleagues couldn't agree more, and so I look forward to working with Chair McHenry on legislative reforms to effectuate those reforms quickly. Again, I thank the witnesses for being here today and doing everything that you could possibly do to respond to the questions and the concerns that you were presented with today. Thank you. I yield back.
I want to thank the ranking member, and I want to thank the ranking member on our joint call for this hearing. The agreement that we had was to pursue this, to find out the facts. I think that's the way the committee comported itself today. I think I won't speak ill of the Senate, but you had a hearing yesterday, and this today was a different hearing. That was the expectation that the ranking member and I both had, and I think it met those expectations. But bottom line for you as the panel, there's bipartisan frustration with many of your answers. There's a question of accountability and an appearance of a lack of accountability. I hope you hear this clearly, not as a partisan act, but as a sincere concern. I think furthermore, there's a lack of transparency. Transparency in the decision-making by you sitting on this panel to answer for your decisions in that week and that first weekend. And while I think we're able to start painting a picture of what happened, there's still much that we need to understand, specifically timelines of what you knew when and how you responded. I think those are very important things for you three on this panel to answer fully for in the name of transparency, but frankly, in the name of building confidence. So there are still questions that somehow, after 3 weeks, that many of you have given here, that you're going to check with staff. You're not sure. This was not a gotcha hearing. This is not a surprise thing. We expect a little more detail than what you provided in many of your answers, specifically the timeline, the data used, and the evidence for your decision-making. And we need leadership. Leadership in that key moment of that week, we want to understand that, the decisions, the decision-making. And we've put you in these positions, you're all Senate confirmed, in very powerful positions in our government. We want you to be capable of achieving good outcomes for the American people and the American economy. We want you to be competent in carrying that out, and that's why we have oversight. And over 5 hours in, you've certainly submitted yourselves to oversight. We will have written questions. For the record, we ask that you respond in a timely manner. But the final note I'll say is understand, in a time where there may be a bit of a political divide in America, I don't think you heard that, by and large, in this hearing, both sides of the aisle. There's sincere concern. And so we ask you to submit in writing these questions. And we know here on Capitol Hill that our work's not done. And we will have oversight of this, independent of your actions and your coordinated effort on oversight with these reports. So I'd like to thank Vice Chair Barr, Chairman Gruenberg, Undersecretary Liang. Thank you for being here today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. The questions will be forwarded to them for a response. I would ask the witnesses and their team behind them to respond no later than April 28th, 2023, as you certainly work to your self-imposed deadline of May 1st. We are also working to conduct our review together with a Government Accountability Office. We ask for your full participation in data and evidence in particular to support that investigation and oversight. The hearing is adjourned.